We're going to be going over the main pillars of the algo. For our first block, we're going to be recapping inducement, engineered liquidity, and SMT review. Now, if you guys have noticed, compared to the previous days, there was an outline for each section where it would say the day one, the overview, day two overview, day three, day four. Day three, day four, like mentioned, I flipped the days, and on top of that, I actually added in new information. So just at a glance for today, I can tell you guys, we are going to be reviewing everything about the algo for the first block. The second block, we are going to be going over the cheat code, aka the blueprint to the matrix, the mastermind setups, and a new probability ranking system that's going to ensure you take the highest quality trades with a rule-based approach, but that's going to give you opportunity to, choose these trades, choose the setups that you want, but ensuring they're always going to be the highest probability. And you guys will see what I mean here in just a couple hours. And then the third block is going to be dedicated to the mastermind entries. This previous boot camp, or the boot camp before this one, we had a ton of information. The boot camp was 30 plus hours, quite a haul. This boot camp going forward, we are only talking about the highest probability, absolutely everything for the entries. Consistency is doing the same thing consistently, right? Choosing the same entries, the same POIs, the same inducements. Even though it has been, maybe understood from you guys, I can make sense of anything and take everything, that's not where consistency lies. Understanding that you have the ability to take any trade that you see, but consciously choosing not to and following a rule-based systematic approach is what's going to guarantee you longevity and consistency in the long run. So please do not let that go over your head. So important. Less is more, and you guys are going to be learning that specifically today. All right. Let's get right into it. All right, everyone. So in the first block, in this section, you guys can expect to learn the proper application and purpose of inducements reviewed, mastering engineered liquidity, the transactional point of the algorithm, how to develop an algorithmic mindset with derived intention, and then, of course, the final steps preparing you for algo mastery. Block one is going to be quite the haul today, everyone. So make sure you have some water, coffee, energy drink, whatever you need, because we have quite a lot to get through. Before I continue, how's everyone doing today? How's everyone ready for day three of the boot camp? Let's get
Yes, sir.
Awesome. Let's get a whole bunch of yes in the chats. Who's ready?
Before you start, Griffin, I have one quick question for the new students.
Go for it.
What do you guys think about day 1 and 2 so far? I see some of you posting some awesome backcasting sessions, some awesome trades. So what do you guys think about day 1 and day 2 so far for the new students? You guys hear me? Yeah, go on mute. Oh. Okay. Match accuracy, amazing. Right, good stuff. You got funded. Oh, great. Nice, Alvaro. Nice, bro. That's sweet.
I was already funded. What? Got me funded. That's awesome. It's great setup, seeing differently now.
Don't worry, Marcus. I got you.
Let's see. Start here in just a minute, everybody.
Salvador, you got funded 20K. Great. Awesome.
Amazing knowledge, got funded 200K. Or 20K. Awesome. All right, everyone. Let's get right to it. Love it. Beginning of much to come. All right, everyone. So let's get right into it. Inducement review, the why behind price. Oops, hold on, everyone. What the heck? No. Hold on, y'all. 1 second. This is not the right one. Let me go to here. Oh boy, dude. Hold on, everybody. Just a moment. Where in the world? What did this know? I see what I did. Okay. All right, everyone. So what we're going to start with today, and my apologies for that little delay. What we're going to start with today is actually, before we get right into it, we're going to start with your current understanding of the knowledge. So first things first, everyone, we're gonna start with our warm-up. So we're gonna send you guys out into breakout rooms, and I'm going to send you guys this image in Discord. So we're gonna give you guys 10 minutes to answer all 8 of these questions. We're gonna have 8 different groups, and we're gonna have a leader for each group. So whoever wants to be the leader of the group, take initiative. You're going to be the spokesperson for your breakout room. So you're gonna be given 10 minutes. You're gonna have 10 minutes to answer all 8 of these questions. You're going to have to identify, talk about it, and of course, the leader of your group is going to give the answer. Now, again, you're not going to be answering all 8 questions to me. You're going to be answering all 8 questions as a group, and then thereafter, you're the spokesman, your leader of your group. I'm going to be calling on your group, and you guys are going to answer the question that I'm asking. All right? Does anyone have any questions on that? All right, so let's do this. You got 8. All right, so this is going to be 1, 2, 3. Open all rooms. All right, everyone. So there's gonna be about 40 guys in each room. I'm gonna give you guys 10 minutes to go through all of this again. Select, you guys are gonna choose your leader, or you guys are gonna stand up and stand the leader of the group, answer the questions, and then in 10 minutes, we'll be right back and you guys are gonna answer this. We're gonna walk through this together. So the rooms are now open. I'm going to be sending you guys this picture in Discord, and you guys can refer to it, and we'll go ahead and get started from there.
And with that, you're in room number 4.
I'll upload this now to everybody. Here, file. Access here. Want to? I don't know if you're able to go to the. All right, Antoine, I'll be back here in 10 minutes. Let me know if you need anything.
All right, no problem. Cool.
Yeah, my computer.
All right, cool.
All right, man. And maybe if you want to, I don't know if you're able to go to the groups and check in if you want. I'm not sure if you can do that, so just let me know if that's something.
Let me check.
No worries. They have 1 minute remaining. So much to go through today. You know, Antoine, closing now. We have the engineer liquidity video. I know we didn't talk about it, too much yesterday, the last bootcamp tape. There's just a lot of information. I'm wondering whether or not to save that till afterwards. It's like a 22-minute video.
Afterwards, I mean, when we finish, or before we finish, or after tomorrow, or after the bootcamp?
Yeah, either after the bootcamp, because there's just so much to go through today.
Yeah, after the bootcamp then.
Yeah, I know it's important, but I'm just like, you know what?
Yeah, it's very important, but yeah, it's a 20-minute video. Yeah, after the bootcamp.
Yeah, for sure. Hopefully that was enough time for everybody.
I mean, if we finish ahead of schedule, then you can do it today, but if it's not, after the bootcamp.
Yeah, we will. We'll see. Interesting. Mateus is in the waiting room, by the way.
Okay.
All right, everyone. How was that? How was the warm-up for everyone? Go ahead and type in the chat what your thoughts were. Oh man. Yeah. I'll have to keep working with the breakout rooms. I'm not sure if that's a feature or not. It would have been definitely easier to share screens, but in the meantime, with what has a picture with all the answers. Yeah, well, I don't think so. I deleted it. I didn't realize for like the first minute, but hopefully it was good for everyone. So what I'm going to do now is I'm going to go through. Yeah. All right. Play. So made it difficult. Yeah, man, I get that. Well, we'll work through it. But hopefully you guys were able to somewhat understand. And if not, well, I guess I'll leave that up to the leaders. All right. So cool. All right. Glad to hear it. Okay, everyone. So we're just gonna go ahead and answer these practice questions. All right. So first things first, I'm gonna ask team 4, room 4, what was the main trend of the structure? Whoever the leader is, if you can I would unmute your mic and analyze on the chart based on your information. What was the main trend structure of room 4? All right. Well, I will allow you guys to mute yourselves again. Swiftness. All right, everyone. I'm now allowing you guys to unmute yourself. All right, leader from room 4. If you can talk and identify the main structure, take 10 seconds to do so we can move on.
Griffin, I think that we don't actually know which group we were in, to be honest. That's why nobody's answering.
Well, how about this? How about the leaders of whatever group that you were a part of? Let's just do by leader then. Whatever leader wants to stand up, one from each group, I'm just going to go through the questions. So Whichever leader would like to answer the first question, let's go through. All right, Zane wants to take it upon himself. Zane, can you explain to us why you identified that as the main trend structure?
Griffin, just as an FYI, Zane has his 2-year-old son. So he might not be able to talk.
All right, well, assuming that's correct, Zane, well, what Antoine said I was referring to. Yes, this is our main trend structure. Now, we'll answer specifically why this is our main trend structure, which is correct. But let's go ahead and have the next group or room leader identify the internal structure. So whichever leader wants to take on that, what is the internal structure?
Actually, I am the leader of room number 8. Eunice, I can go?
Yes, sir.
Okay, the internal structure, actually, as mentioned by Zane, this is we have a bigger structure. The internal structure we have here, we can go like this. This is the most obvious internal structure for me. And also,
yes, sir. Correct, right? Yeah. One thing to always note when we are doing this internal structure, right? You got it absolutely correct. When we're looking at internal structure, everybody, we first need to understand clear viewers drawings. We first need to understand if this is going to be our main trend, right? Within each leg, it doesn't matter if this is a 4-hour structure, if this is 15-minute. Within each main structure leg, you're always gonna have internal structure. So what you need to do is if this is our main structure leg, we need to see how it is internally delivered, right? So we need to see that we have some form of high, low, lower high, lower low. This is where structure first broke, which tells us based on the analysis of our main time frame, we can assume that it looks potentially something like this. So this is all going to be our internal structure. As soon as this internal structural low is broken, that tells us the lower time frame is now aligned with the higher time frame, and this was the reason for its expansion. Now again, internal structure, right? To your point, Eunice, yes, this is all internal, but we want to have it, make sense. So like you have illustrated, where's the next internal lower high? Well, we can see the next internal lower high would be potentially maybe somewhere around here, right? This makes a new high. Then we see that we have some form of BOS, right? BOS. This now aligns back with our higher time frame, and price then continues lower. So this is our main and our internal structure. So if I had to ask you what is the current range of our internal trend, Eunice, what would you say?
The main trend from here to here.
The internal trend. Where's the last lower high and lower low?
The last.
You got it, right? So this is our last internal lower high and then our lower low, right?
No.
Correct. Awesome. All right. Now that we have all this identified, the next thing that I'm going to ask is, of course, what? The next leader, go ahead and identify what are the main inducements then? What are the main inducements?
Griffin, can I say something before we move on to the next point?
Yes, sir, Mr. V.
I want to ask because I think this is an error that I commit very frequently, because I often think that this is like the main trend. Excuse me. Like this in here, I believe that this POI will hold because just watching this PA, right? Because for me, for this to be a valid range from here to here, I think, or for what I've seen, that this has to break some other level over here to validate the entire range. I don't know if that makes sense or.
Yeah, bro. So I would definitely write that down as a question, but in regards to your answer, we need to identify a main and an internal range. If you were to say you have a high, low, lower, high, lower, low, based on this one time frame, do you see any internal range within here? Well, nothing that's obvious. You don't see any internal range. So for this example, the reason we're saying this is the main range right here is because this is the only clear internal lower low, internal lower high, lower low. So that's why we're just using this as an internal range just for this example. But for one of your questions, I would definitely write down how to properly navigate trading ranges. And that's something I'd be more than happy to go through and explain tomorrow, because I know that a lot of people are going to have that same question.
Okay, thanks, man.
You're welcome, bro. All right, so now that we have our main range and our internal range, I want one of the leaders to please identify where's the main inducement. Where are the main inducements here? Where the main
the main inducements are the structural points of the main plane structure. The eyes on them. Let me see if I can locate them. Yeah. Yeah.
Yes, sir. Good job. Right. You got it right. So our main inducements are our main structural points. They're always going to be our main trend structure. Again, we mark structure so we know the inducements, right? So we know that both of these areas, they're structure, but they're also the inducement points, meaning they tell us the destinations, right? So now, good job, man. Who can answer question 4? Another leader. Where are the internal inducements, aka the gas stations?
I'll go for number 4.
Oh,
I'll go for it. You got it.
You got the next one, brother.
No worries.
All right. Mr. Medat, can you explain why that is internal inducement?
That's the recent high for liquidity line.
Yes, sir. Right. Internal structural points, right? So we know that we look to sell above lower highs, right? So internally, we see that we have some form of internal low, internal lower high, internal lower low. So this is going to be our inducement right here, aka our gas station, right? Additionally, what we also have Medad is where's the other internal inducement?
From where we have to grab liquidity, you mean the bottom to
Mhm.
target this one?
There's a key thing that I already put for an SMT. Where's the inducement before there?
Okay. Okay, if we use fractality, that's the inducement, the recent inducement.
Mhm.
Before
for
we target high.
Right, for the main range, this is the inducement, but the internal range, actually, remember how we have low, lower, high, lower, low? This
Yeah.
is also an inducement
Yep.
before our SMT. So we're collecting liquidity before the SMT. So we actually have our internal low. This is an inducement down here. So we're taking out here sell side liquidity, right? Now we have buy side liquidity mapped out here. So the next question, number 5, was it Raymond?
Sorry, I was muted.
You're good,
Is
brother.
the engineered liquidity about the same as SMT?
Engineered liquidity is the liquidity that I know we didn't practice it too much, but it's the liquidity point within range where price randomly picks up after imbalance.
Price randomly picks up after imbalance.
Sure.
Because my initial answer was going to be, let's see, definitely some type of trendline liquidity there, and
Mhm.
also the SMTs without drawing them out too soon,
Mhm.
because obviously those are traps setting up liquidity for traders to get in too soon.
Sure. Yeah, man. While that is correct, actually, engineered liquidity, we didn't talk too much about it last session. Engineered liquidity is the point that price picks up. If we're in a bearish trend, right? If we're in a bearish trend, it's the first point where price picks up and then starts to go lower. So this is our engineered liquidity point. So based on this, if we're bearish, can you identify where price first picks up after an imbalance to the left?
Yeah, I would mark it by these highs right here,
All right.
where price picks up and drops.
Yeah, so this is definitely an area of engineered liquidity right here. Also, we have another area of engineered liquidity, which actually lies up here. So we have engineered liquidity within our main range, which is right here. And then we also have our area of engineered liquidity right here, where we have our other purple line drawn, right? So this area of engineered liquidity, why do we call it engineered liquidity? Because what happens is after that first imbalance occurs, price fails to mitigate, and then it just runs away afterwards. So right here, after major imbalance, price will not mitigate anything, and then it'll just continue to go lower. So again, if we look the buy side, where is our first imbalance? It's right here. After imbalance, does this candle mitigate anything to the left? Nope. And what happens after? Price keeps falling off. So this is our point within the main range. This is our engineered liquidity. And within our internal range for this range, right? Because everything is always going to be fractal. Where is the point that price does not mitigate anything to the left? Well, it's right here. This point doesn't mitigate anything. And then price does what? Starts to create some form of order flow to then break this low. So we have 2 points of engineered liquidity. One is right here and the other is right here. All right. So let's go ahead and have number 6, identify all relevant SMTs. Where are the false order blocks in the pro trend and counter trend scenario? Mr. J. Wilson, go for it, brother.
Not sure if you can hear me. My mic is a little weird today.
I can hear you perfect. Perfect. So
The smart money trap right over here. You know, I can't necessarily explain it too well. Only I know how it looks because I've gotten caught in them a few times when I was trading.
Mhm.
That's kind of like my way of identifying because I've been in the trap a few times.
Okay, sure. Yeah, so there are 2 smart money traps in this scenario, and smart money traps are the order blocks that appear to be structurally supported, but they are actually not. So based on this order block, because we have a lower high and a lower low, this right here, many traders would think that, oh, we're looking to sell here because, oh, we're bearish. But in fact, we are bearish, but because we are targeting a higher time frame destination, we need gas to get there, and the gas is above this high. So any order blocks that lie within this internal range are smart money traps because we have to go above this high before going lower, even though on a lower time frame, again, traders they believe that we are structurally supported for sells, but we're not. We have to go above a high, we have to induce higher before going lower. So any order blocks within here that look like they're selling are incorrect. So with that being said, if this is one SMT, where would one more be within the current range that we're looking at for the purple? Jay, do you know, bro? Take your best guess at it.
I think maybe I'm not.
Just Jay. Let's just do just Jay. Even if you don't know, just take a stab at it. Within this range right here. Whereas another order block that has imbalance for cells that isn't going to work. Key point, it's above here. It's above here.
Okay, wait, sorry.
No, you're good. You're good. Give you 30 more seconds or so, and you're good, man.
Is it like somewhere around in this range? I
Cell
can't-
order block. Cell order block. You're close to it. Right. So this is your SMT. Do you see right here? I would be small imbalance right here.
Oh, okay.
Right. And this is our lower high that makes a lower low within our purple range. So this right here is our next SMT right here. This is our next SMT because again, it appears to be structurally supported. Remember, we always have two order blocks. We have our extreme and our decisional. In this case, because it appears as so an internal time frame, we are bearish, but because we mitigated an SMT, we took out a low, we now need to take out a high. So any of these order blocks that appear for cells, they're just going to cause pullbacks. So these are our SMTs. And we'll review that here in the next few slides. All right, good job, man. Next one. Can anyone tell me now if these are the SMTs, where is the pro trend decisional and extreme? Where is the pro trend main leg decisional and extreme? Let's have some.
I can go for it.
Go for it. Everyone, please remember, only the person being called on answer. So go for it, Mr. Or Judah. All right, and which order block is this?
This one is decisional.
Correct. And where is your extreme?
I think this one is the extreme.
Is there an imbalance?
No.
Where's your extreme? Where's the first imbalance that happens within our main range?
This one. So maybe this one is the extreme.
Right, so right here, let's take a look at this, right? Thank you for your participation, brother. So when we're looking at this, if this is our main higher time frame leg, and we know that we are looking for pro trend cells from this high to this low all the way down here, we want to find our decisional and our extreme. So knowing that both of these are going to be SMTs, they're simply just going to cause pullbacks, right? And then we have to look above. Where is our decisional and our extreme? Starting from the left to the right within our range, where's our first imbalance? No imbalance. Do we have an imbalance here? Yes. So that first imbalance is what creates our extreme order block. So this is our extreme order block for cells right over here. Where's our decisional? Our decisional order block is the second imbalance that's created. So if this is our first one, where's the next imbalance? Well, we can clearly see our next imbalance is right here. So this is our decisional in this case, right? So this is our decisional order block lying just after our inducements. Now we have our extreme and our decisional. And the last thing that we need to identify is creating the higher time frame trade projection based on where price currently is. So if this is where price currently is at an SMT, and we have two valid order blocks, can the last group leader identify based on where price is, how it's going to move to get here, and then where it's going to go afterwards? So have the last group leader identify that, and then we will review.
It is number 8.
Yes, sir.
Okay, from the extreme,
Yes,
I'm
sir.
expecting we can expect a leg of price actually like this to the decision. From the extreme. Yeah, from price, what is actually price? We can see just some reaction from this MT. You need to go. We can mitigate the decisional. We send some few reaction. Then we go to the extreme. Then it should be dropped.
There you go. Right. Yep. Absolutely. And that's all that you would go about it. Right. So exactly like that. If you know where your inducement is into an SMT, and we know that price has to target up here, that tells you any of these order blocks over here, SMTs are just going to cause pullbacks. Right. And can everyone type in the chat when an SMT is mitigated, where price goes back to? Order flow, right? Price goes back to order flow. So after SMT, it'll mitigate here, come up higher to our next SMT. We'll come back to maybe some form of order flow. And then afterwards, where are we targeting? We're targeting this inducement. So then we'll be going up here. Now we're the valid order blocks. Well, we have a decisional, we have our extreme. One of the two is going to work. So what do? We expect price will come to our order block. And this is where the inducement cycle comes into play, right? Because we are literally building up liquidity to take out our internal inducement to create the trap into one of these valid order blocks, and then for price to then reverse and target our new trap, right? Because we're trading essentially trap inducement taken to then a new inducement that creates a new trap. Okay, so that's how we need to envision price. Now, specifically, let's take a look at what happened. Right.
Hello, Griffin, I was going to ask a question just very briefly. Because of our engineered liquidity aligning with our decisional order block.
You got it.
Does it make that order block invalid because it doesn't engineered liquidity?
I'm cutting you off because you're way ahead. You got it. You're absolutely right. Right. So we identified here, and thank you for that point. It's awesome that you identified that. And that's exactly what I'm looking for, is thinking the next step ahead. Right. So in this range, we know we have our lower high and our lower low. Within our internal range, we know that we have, an internal lower high and internal lower low. But this SMT was key here, because when we have an SMT here, that tells us our main range is going to be respected. Now, after we take out liquidity into an order block, in this case, we take out a lower low, that tells us after we take out sell side liquidity, we need to take out buy side liquidity. Sell stops rated, now we have to take out buy stops, and they're lying at structural highs, lower highs and higher highs. So now we know that we're going to be taking out this structure, this inducement to the buy side. What happens is after SMTs are mitigated, they come back to some form of order flow, and then we release, right? Now that we've identified the internal, we know where the main trend, now it's the order block. So where are the valid order blocks? This decisional, right? Why is this decisional actually not valid? To your point, Mr. CC, you just identified that, well, a decisional order block, is it valid when it lies at engineered liquidity? It's actually not. Why is that? Because engineered liquidity is the coin term that we have based on, if there's an order block lying at engineered liquidity, 95+% of the time, if not higher, this order block will not work. So in this case, this decisional, notice what happens. It just breaks right through it. And why did it break right through the decisional? Because the engineered liquidity was lying just above it. So that's why it was not valid here. So that's how we know, by marking this as not a valid decisional, because it lies at engineered liquidity. Make that point. If your order block lies at engineered liquidity, it is not valid. Very important point to note. As soon as that happens, guess what? Well, then you know what your real order block is. It's your extreme. So what's going to happen is rinse and repeat, right? Where's your inducement now before your extreme order block? Can anyone go ahead and identify, before our extreme order block is mitigated over here, where's the last inducement to the right that validates that order block? So you all are right? We actually have this main inducement here that validates it, but we also have, again, our main inducement. We also have an internal one as well. So they both validate this as the correct order block. So after, again, we take out liquidity to the buy side, in this case, it's engineered liquidity. What always needs to happen? We now got to take out some form of sellers below here. After we take out sellers, we need to take out buyers, which are above here. After the buyers are taken, guess where the immediate next target becomes? Mitigation of order block. Where do we know now price must come back to after taking out buyers? You need to take out sellers, right? So now we know that we're going to come back down to here. Boom. After we take out sellers, now we have to take out buyers. So where are the next buys lying? The buys are going to be lying within and above the range. So your next area, exactly, Ratik, beautiful. We have a type 3 within here, right? So we're selling above an internal lower high. This is where the next gas is. So after now we take out buyers, where are the next sellers? Where are the next sell stops that we need to take out? Boom, Trevor, beautiful, right? Now we have to take out down here. So then now we have to do is follow the intention, right? Follow the intention. We ended up, again, following order flow, extreme, price reacted to the extreme, fell away. We actually ended up coming to another refinement of this extreme. And then what happened? Price inevitably ended up selling afterwards. Again, after liquidity is taken, most likely always going to have a rebound, right? Always going to have some form of rebound. And in this instance, what happened is before coming all the way to take outer low, price actually came to an SMT on an extreme level. SMT was mitigated. Now we know we have another SMT in the future over here, especially because we're building all of these equal lows. So that's now going to enable us to rinse and repeat the whole process. We know we've mitigated our lower high. Now, guess what? We're just going to be following all of the internal because our trap has now been created. So now we just follow the internal to target the higher time frame inducement. And again, rinse and repeat. Same thing. Where are your order blocks? Here's your extreme. Here's your decisional right over here. What does price do? Takes out engineered liquidity before a decisional, builds up several inducements before the mitigation. The whole cycle repeats. You have your buildup to your inducement that creates your trap. And then what do we do now? Follow order flow to then target a new inducement that's going to create a new trap. So everyone go ahead and type a 1 in the chat if what I just went through makes sense, or at least on a conceptual level, you're starting to follow. Beautiful. All right, everyone. I know that was a pretty long warm up, but it's always important to really practice what we know, especially as you guys can be working in groups. And the more examples that we go through together, the more breakout rooms and team building that we have, the more used to, the system you're going to be able to be more efficient, answer the questions, and everything is going to improve as we go along. So that's why it's so important. We have high participation. We have, high efficiency, so we can keep moving through all of this to maximize yours and everyone's experience. So let's get right into it, right? Now we've gone through the warm-up, inducement review, the why behind price. Why do we identify inducement? Again, we identify inducement for several reasons. The primary being to capitalize off of the fears, greeds, and hopes of various types of traders. Again, we identify the inducement points so we know where virtually everyone's stop loss is going to be and where, on the contrary, breakout traders' new positions in the opposite direction are going to be, right? So understanding how to think like a breakout trader. Think about what traders don't want to have happen, and then we do exactly that. We have to be able to step outside of our own shoes, think outside of our own perspective. That's what's going to make you different than all other types of traders. You're not using your own bias to confirm trades. You're using many different types of traders' bias and use that against them, like an institution would, right? Imagine price traveling from stop loss to stop loss, from a buy stop loss below low, and then a sell stop loss above a high. Always think like this. And this is what we're going to start ingraining in your brain starting today, especially. Price moves from stop loss to stop loss on every single level, from the higher time frame to the lower time frame. Understanding where traders are getting stopped out, and we look for the entries immediately thereafter. Inducement validates our order blocks. It is the trigger for entry. We don't use BOS to confirm our order blocks. We use inducement because the order blocks stop price after the inducement is rated to then actually reverse it. We identify the wrong trend that traders are induced into seeing in order to be on the right side of the market. Again, like we just previously talked about, why are traders induced into seeing sells here? Why are they actually induced? Can anyone identify on the screen why traders are believing that we're looking for sells here? By what specific point are they being induced to see sells? Exactly, right? They're viewing this as a BOS. So any structural change that comes into play, whenever you see structure broken, think about it. Where is structure broken? Making new highs, new lows, reversal structure. That point it's broken is specifically where traders are induced into the wrong direction. So if they're seeing sells, we know that we're going to look for an order block below here to then trade in the opposite direction. And inducement is so powerful, and the reason we use it is in conjunction with all that we've just identified. It tells us and makes sure specifically that we are never going to take dumb losses. Meaning, if maybe you thought an order block was mitigated, maybe this is where you're following order flow. Oftentimes what you're going to see is, oh, here's my order block, and then I want it to go higher. It's oftentimes going to cause you to get stopped out, and then it's going to reverse, right? So how does inducement actually impact us? By identifying lows always to buy below, it's going to ensure at the very minimum, if price isn't reversed as a whole, it at least ensures that we're going to get a reaction. This reaction could just be, it could just be here to go lower. Again, we buy below structure and we sell above it to ensure at the minimum we're going to be getting a reaction, because who knows, that main structure range could maintain, but by buying below a previous low or a previous high, selling above, it's going to ensure at the minimum we're going to have some form of pullback, and it's up to the amount of gas collected and the type of order block that's mitigated that's actually going to tell us if price will end up breaking the range. In this case, why would it not break the range here? Well, clearly we're at an SMT and price won't break it. So there's levels and levels of understanding, but just to put it in the back of y'all's minds, we use inducement for so many purposes. It's also the initiation point of the algo that you guys have learned previously last week, and also what you're going to be reviewing today. So how we apply inducement. Remember, all different types of inducements, minor, medium, and major. It's all of the structural points. You have to properly be able to know how to identify multi-time frame structure, because that tells you specifically where your inducements are. If you can't mark structure, you can't mark inducements, because inducement is structure, right? But what validates structure is liquidity. All being said, inducement, the application helps us create a logical roadmap demonstrating how price should move from the lower time frame to the higher time frame. Case in point, if we know this is our higher time frame potential trend, and maybe it's solidified at this point in time, and we know within our internal range, we're always going to have this, and maybe an order block was mitigated. Well, because we took out some form of higher time frame low, think about it. We took out some form of sell side liquidity. Where's the first area we must come back to at the minimum to balance stop loss is stop loss. Exactly, Mr. Villafuerte, right? We need to come all the way back up to here. And specifically, not just based on the balance of the checks and balances of the algorithm, but it's also going to be the gas that's going to allow us to then continue lower. So understanding how it's moving from the lower time frame to the higher time frame is essential. You know, maybe even in this scenario, you could have your valid extreme up here. Well, if this is where price is currently, what do we need in order to get up to there, right? In order for us to get up to here, what do we need? We need gas. So maybe after you take out some sell side or buy side liquidity, now guess what? We might have to take out sells, and then in order to be able to come all the way up here. And then after we take out buys, guess what? Now we need to take out new sells down here. So build you your roadmap to understand where price is actually going. So after identifying how price should move to get to that destination, the last thing you need to do is just identify the valid order blocks lying after your decisional and your extreme. Without a doubt, this is one of the most important concepts that, we don't teach in, the boot camp specifically. You guys watch on the first day, but if you become a master at choosing the right order blocks, that's like half the battle. If you can make perfect refinements, understand how to approach your order blocks, all that's left to do is liquidity. So then you know where any price needs to come. So identifying those order blocks ensures that you have the right refinements, and also ensures beforehand that traders' stop losses are going to be liquidated. That's going to cause price to reverse, right? Two things needed to go anywhere: enough gas collected, and also a strong enough order block to actually cause price to reverse. You can't have one without the other, right? Lastly, utilizing inducements for trade management and liquidity targets. The same way that you should be entering is the same way you need to be exiting. Everything is the same, because when you exit, that should just tell you it's an entry in the opposite direction. So how do you actually manage a trade using inducements for break evens? I saw someone in the chat ask, here is our valid order block. What happens if it's already mitigated, right? And I say this time and time again, when your order block is mitigated, and let's say now it comes to a new low, oftentimes many people say, I want to break even at this point. While that is valid, we always need to understand this high could actually just be an inducement to come even deeper before the whole sell-off. So trade management and inducement, that's how you're going to be breaking even. That's how you're going to be taking partials. That's how you're going to be, managing your stop losses and taking profit, right? Taking profit is huge, because according to the algo, when you start to master the anatomy come today, you're going to realize there are some very key places to always take out according to. If you manage your trade according to how the algo delivers, it's virtually guaranteed that you're going to have a positive win rate all the time, because trade management is key. It doesn't matter what strategy you utilize at the end of the day. If you don't know how to manage a trade and you're always wanting to hold it till it goes to that 1 to 20, 1 to 30, that is the dumbest way to trade, because you could be waiting so long for price either A, to never get there, or B, just cut out the winnings that you could have. So taking partials is going to be key to longevity and to really amplifying your trading account. All right. Smart money traps, right? Very important. Key. Inducement is the key to identifying correct SMTs, right? Because SMTs, remember, what are they? SMTs are order blocks that appear to be structurally supported. Like we talked about, they're within that last lower low, lower high. Well, why would they not be valid? Because that's actually the lower time frame trend inducing traders to see it. So remember, continuation inducements, as you're going to see here in the next slide, continuation inducements are what we call type 1 and type 3. These are what we call continuation inducements. By nature, traders who trade based off of structure call these reversals. So you can imagine, based on our type 1 and type 3 inducements, these traders are going to be looking for, oh, here's our BOS. Now I'm going to look in the opposite direction. They're being induced into seeing that. So with that being said, if they see, oh, here's our BOS, where is their inducement going to lie in this scenario? Well, their SMTs are going to lie at the higher lows right after this BOS. And more importantly, because they're only trading structure and they think this is going to happen beforehand, their SMT is also going to be lying over here, because, oh, here's my right order block, but it's not going to work, right? So this isn't going to work. It's going to trap them in one direction. They're going to think, oh, if it's not sells, it's buys. Then guess what? Here's their SMT here. And it's just going to end up failing both ways. So this type of setup occurs when after price randomly stops to the left, right? If it doesn't mitigate anything and it has a pullback, this is what you can expect. Also, if it mitigates a smart money trap or a false OB, this is what you can expect. Trapping traders in both directions, right? So reversal inducements are what we use for reversals, and this induced continuation traders, right? So again, if traders say, oh, here's our higher low and our higher high, what are they thinking? They're thinking continuations. we need to think we're using this against them. So we're using this as reversals. So where's our inducement in this scenario where traders are trapped to seeing continuations, right? Go ahead and everyone identify where is our reversal inducement in this instance from our perspective, right? Induce continuation traders. Remember, everybody, let me replay this. Where are continuation traders induced if the move's already happened? What point do they believe now we have new highs and new lows? Here, right? This is inducing continuation. Why are they saying continuation? Because they saw a previous high broken. When they see a previous high broken, they're thinking, oh, we're going to be continue buying up. We use this for, this is a type 2 inducement, everybody. We use this for reversals. We sell above highs. We buy below lower lows. Traders are induced to see this when in reality, the opposite's going to happen, right? When in reality, the opposite is going to happen. So the SMT is going to lie here. It is going to lie here. So we look for price to have a small reaction and break in the opposite direction. Small reaction, break in the opposite direction. Small reaction, break in the opposite direction. So if you've ever identified an order block you thought was structurally supported, I guarantee you've seen this happen more than once because you've probably gotten caught in this. Type a 1 in the chat if you've been caught in a scenario like this before. Beautiful. Now you're going to learn how to not get trapped in it. So the key takeaways about SMCs, everybody. Your perception of SMTs, they are specifically based on what you consider to be an inducement versus true structure, right? If you consider this a lower high to sell above, you know your SMT is going to be here, right? If you consider this in this scenario, let's say you consider this a valid BOS, this is going to be an order, this is going to be a valid order block rather than an inducement. And what tells you again where SMTs are going to be lying is inducement, specifically what this point to the left mitigates. If it mitigates the correct order block and we're bullish over here, well, do you think this is going to be an inducement or is it going to be a BOS? Are we going to be using this to sell down or are we going to be using this for a pullback to sell higher or to buy higher? Well, if it mitigated the correct order block, we know that our perspective mitigated the correct order block. This is actually going to be right buys. So it's going to be a true BOS and not an inducement. So if you don't think it's an SMT, right? If you don't think that this over here is an SMT, that's going to tell you that price means it mitigated the correct order block. If it's not an SMT, if this is an SMT, it tells you price did not mitigate the correct order block. So I'll give you guys 30 seconds or so to write down some notes, and I'm going to go on to the next slide. Everyone type 1 in the chat when you're ready to continue. Everyone type 1 in the chat when you are ready to continue. To it, everyone. Great. All right. SMT diagrams, right? We're going to go right through these again. Type 1 SMTs, remember, this type of reaction, it occurs when price reacts or mitigates from a false OB to the left. Meaning, over here, what happens when you have a high that mitigates an incorrect SMT, what's going to happen is that's going to now induce traders to believe, oh, here's no BOS, here are sells. When they see this, they're automatically looking for an order block over here. So in a type 1 scenario, remember, it's inducing traders in the wrong direction, a BOS. We view this for a type 1 as a continuation trade. So when a higher low is taken in an uptrend, and that high, that if it doesn't mitigate anything relevant and it creates a BOS, think that's an inducement. Automatically think, did it mitigate anything relevant? No, it's a type 1 inducement. So that means if this didn't mitigate anything relevant and it creates a BOS, that's going to tell you that this is going to be your SMT. So what's going to happen is, again, does it mitigate anything relevant? Here's your inducement. That means you're going to be following the correct trend. You're going to be following the correct direction. And you're going to be utilizing this SMT as a pullback to then target that new high. So case in point, remember, let's say over here, this is your trend. And maybe this is where the correct order block is. Over here, let's say you have an order block and maybe it lies at break and retest, right? What you can expect from this scenario, and I would draw out this exactly, everybody. So let's say this is mitigated, but it's not the right order block. It's not the valid decisional. It doesn't meet the criteria. Let's say you see something like this. and it's not the right one. Do not panic. Do not worry. Oh, it's running away. I go look for sells. Absolutely not. Conquer your emotions. Know the purpose of it. They're inducing traders to be looking for sells. So this is going to be our type 1 inducement. Based on this pattern, where are we going to be looking to buy? We're going to be looking to buy right below. We're going to be looking to buy right down here. Exactly, Trevor. Right? So then that tells us if this is our correct order block, this is our SMT, then our next wrong SMT is going to be lying just over here. Right? Because traders seeing this as a BOS. Now they're viewing this as an extreme order block. Not going to work. So now we need to be following the internal trend, because what's going to happen is it will then just break. And this is, for those who know Wyckoff schematics, this is a reaccumulation that takes place. And the liquidity cycle, the algo cycle, is what builds these accumulations, reaccumulation, distributions, redistribution, so on and so forth. Right? So for this, I would draw exactly that. I'll give you guys 10 seconds and I'm going to move on to the next. Great. All right, everyone, move on to the next one. 3, 2, 1, let's go. The next type 1 inducement is sells, right? It's a sell, or it's a buy inducement and a sell trend. So like we were just talking about, let's say that we are in a sell trend, or my bad. Let's say that we are in a bullish trend over here. Let's say that this is your correct order block. And let's say maybe over here is not a correct one, right? Well, what's going to happen is you're going to see something that looks like this. Oh, here's the order block, right? What do you expect? What's going to happen is price will create, oh, here's our BOS, right? Here's our BOS. So what traders are going to think, oh, we're looking for, right, buy continuations now. So what happens is after they get this BOS, which we see as a reversal, right? We sell above highs. What's going to happen is it's just going to mitigate some form of order block to the left, because we know this is invalid. So that tells us after this BOS, this is where our SMT is. Then what's going to happen from there? Price will come mitigate, come back to our order flow. And then guess what? It's going to continue lower. This is something you will see absolutely all the time. This is how I always get my phenomenal scale in positions, because following internal, you have to know it's going to follow internal before it goes anywhere else. So draw this diagram exactly over here. Again, I'll give everyone 15 seconds or so, and then I'm going to move on to the next. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. All right. The next type is our type 2 inducement, all right? So our type 2 inducement occurs when traders are induced into the opposite direction. So case in point over here, what's going to happen is compared to the first scenario, when price was selling randomly and, when it was barely in the middle of the trend, this is the right order block. What happens in a type 2 scenario is this occurs when price reacts from the true higher time frame order block. Again, this is your cheat sheet. So when price mitigates the true order block, let's say this is our true order block over here. Remember what happens on the lower time frame. Traders are always getting trapped on the lower time frame. They're not zooming out, right? So what happens is they're going to see something that looks like this. Lower time frame traders, why are they induced to seeing buys? They're induced to seeing buys as soon as this high is broken. But what happens is the mitigation of the correct order block occurs. So what we utilize type 2 is for reversals, because these traders are viewing for continuations. We use them for reversals. So as soon as the higher time frame order block is mitigated right here, then we can expect what? This will be our SMT, our wrong order block. Price will then do something like this. It'll come to mitigate it, and it won't create a BOS beforehand. It'll just mitigate your SMT to cause a pullback. And here you're just going to identify your correct order block following fractal order flow for then it to break lower. So this is going to be one of the confirmations you guys are going to be learning as it pertains to entries, because your POIs and your entries are the same, just on different time frames. You're not going to wait for a BOS at times. What pricing can do is just going to come to an SMT, come back to your extreme, and then it's going to sell off. So this is how it looks for a type 2. Again, I'll give everyone 10 seconds, and then we are going to continue. 8, 7, 6, 5, 4, 3, 2, 1. I know it's a little rushed, everybody, but we got a lot to go through. All right, and the last type 2 is going to be in this scenario. So again, what happens here? This is assuming that the higher time frame correct order block is mitigated. Again, this is your cheat sheet. This is everything you need to know for the different setups as you're going to be learning in the second block, right? As soon as your higher time frame order block is mitigated, you have your SMT at that last lower high, because you have internal traders who are focusing on the sells. So what's going to happen is it's going to give them a little bit of hope. Like you guys had mentioned, you guys have taken a lot of losses this way. You have a little reaction, and then price will break right through. You're using the SMT to come back down to your extreme. Again, following order flow. Once this is mitigated here, this is where the money transfers, and that's the order block that needs to be mitigated. And then you simply expect price to then target a new high. So that these are the type 2. Type 2 is when price mitigates the correct order block. Type 1 is when price mitigates the false order block. So everyone, again, 10, 15 seconds, write it down, and then we will continue on to the next. And just to remind everyone, please be mindful, red asterisks. If anyone is taking cotton pictures using their phone, Antoine and myself will be kicking you guys from today. We're avidly watching. All right, guys. So we give about 5 more seconds, and then we're going to go on to the next. All right, on to the next. We have some practice and a few more things for block 1. Okay. All right. Now what I want you guys to do is we're going to take a little bit of practice. So now what you guys are going to be doing is identifying the SMT based on the inducement. Remember, for the key point before we went to SMTs, the inducement tells you where the SMT is. So I encourage everyone, do not play follow the leader. Follow your notes and identify where the true SMT is. All right, so we have 2 examples we're going to go through right now. All right, identify the SMT. So what we're illustrating, before anyone marks anything, we are illustrating this scenario that this is the inducement. If this is the inducement, everybody, I want you guys to take 10 seconds and identify where is the SMT based on a type 2 inducement. Everyone look at your notes. Remember, don't play follow the leader, look at your notes and do what you think is best. I remember everyone participation. Had 8 people. Even if you think you know it, still show it. All right. So let's see. We've identified the inducement, we identified the SMT. So now what I want everyone to do is please now draw, based on your projection of the SMT, draw the reaction from where price currently is and the movement you think is going to happen afterwards. So where price is up here, make a projection. Yep, as Mr. Bashant's doing. Beautiful, beautiful, beautiful. And let's just see how everyone analyze. You got it, Matthias. We have Matthias too. Exactly that, right? As soon as your inducement is taken, and assuming that we've mitigated the correct order block, what do? We simply just follow the order flow to where? That actually comes back to mitigate our SMT. And once our SMT is mitigated here, it just comes back to order flow. And where does price thereafter go? Well, again, little advanced concept, but if there is, again, imbalance, mitigated imbalance, everything has been mitigated. What does this tell us? What does this build if everything is efficient? If everything is efficient, can anyone tell me what? I'm sure I got to delete your answer, bro. You're way too fast. Exactly. For those who don't know, we will be learning today, this is what we consider a wall. When there's no imbalance left, all the imbalance has been taken care of. Again, this is the last imbalance. It was mitigated. This creates all efficient price, meaning there's no imbalances. And when there's no imbalances, that tells you a whole wall occurs. Now, where's the next imbalance that happens after the wall? Well, over here, this is where the next imbalance is after the wall. So this is where price should come down to first and have some form of a pullback, right? So if this is our whole wall up here, that tells us, now guess what? All we're doing is focusing on the internal trend. And what happens? Exactly that, right? It's mitigated order flow. We know we're going to be targeting here for our first area. And then happens order flow, order flow, order flow, order flow, order flow, release. So that's where I've coined the term trap and stack, because it's based off of the algorithm. It's always going to be the same, right? So if this is the inducement, this is our SMT, and then we know where price is going to go all the way lower. And when you're able to identify and do this on your own and have so much backtest, excuse me, have that backtesting experience, it's going to enable you to have such a high level of confidence when taking your positions, because you know, you've done this so many times, you know what's going to happen. All right, now let's go to the next question. So based on this scenario, everybody, I have identified the valid sell range. Assuming that this valid sell range is going to hold, where is the internal inducement? Everyone only identify the inducement first. Beautiful, right? So assuming that this is our current sell range and we are projecting what's going to happen, if we're looking for sells to continue, right? If we're looking for sells, that means we are expecting that new lows are going to be made. But where's the internal point where traders are going to be induced? Well, to know where that is, you have to know where the internal structure is. So we see over here, high, higher, low, higher, high. This is where structure shifted. We identify always before lower high, lower low, we need to always start left to right. So now after we see where the BOS happened, we know where the internal first occurred to start the main leg. Now we have this lower high, lower low. This low is broken over here. Now we have a lower high and a lower low. Everyone in the chat, type what type of inducement this is right here. Everyone in the chat, type what type of inducement this is. Look at your notes, take a second, and let's see. Right, good. This is a type 3 inducement. Remember, type 1 is only relevant to the main leg. If this is our main leg, this is going to be selling above a higher time frame or a main leg high. This is the type 1. The type 3 is the same thing, but it happens on an internal leg. So this tells us we need to be selling above here. So this is our inducement point. Now, the next thing I want to ask, right, if this is our inducement point, where is the SMT? Where is the order block that traders are looking at that appears to be structurally supported based off of the inducement, everybody? Based on the inducement, what order block are they viewing that's going to be having relevance? Awesome, right? With 3L's drawings. So based on this, if they're looking for buys, essentially any order block that is holding buy precedence is going to be wrong, because this is going to be a type, right? This is going to be a type 2 inducement that we are going to be looking for order blocks, right? Because they're going to be looking for order blocks within here. Oops. So that tells us any of these order blocks are going to be wrong. So where are the order blocks with imbalance? Well, here for sure is going to be an SMT. Also, where's going to be the next SMT? That has already been mitigated, right? There's no more imbalance, which tells us this is a wall. Our next imbalance is right here. So these are our 2 SMTs. And what type of reaction do we expect when price comes back to these SMTs? Well, we're going to expect price to have, Trevor, don't you dare press it. Try to lecture. Kidding, bro. You're going to expect pullbacks, just pullbacks to then sell lower. So SMTs, these are areas where dumb traders try to catch these pullbacks or hedge, right? These hedge are not worth the position unless they have relevance. Here specifically, none of these are going to have any relevance. So we're just going to look for quick pullbacks. So again, identify the inducement, you know exactly where the SMTs are. So let's see how it happened. And exactly as so, right? If this was our correct order block, as some of you guys identified, based on the main trend, right? We're looking to sell. This is our first push, our second push that caused this. This is our decisional. This is our extreme up here. Price mitigated the decisional. How do we know it was going to be the decisional? Well, because the inducement was very close to it. So what happens after the inducement was taken into our decisional? Think about the inducement cycle. Always remember, your inducement cycle goes to build up towards the inducement. So we're building up towards the inducement. We then trap traders in the wrong direction after it's broken. The trap occurs once that correct order block is mitigated. After the correct order block is mitigated, we then need to identify where these SMTs are. We identified where the SMTs are. The SMTs are lying over here and over here. So at this point, what do? After the trap happens, we then follow order flow. So trap, here's the trap. Guess what? Here's the order flow. Here is the order flow. And guess what? Price then sells all the way down to this bad guy over here, which everyone in the chat, even if you know it, if you don't know it, what do we call this point where the dotted line is? What do we call this point right over here? Beautiful, right? Engineered liquidity. So now when this engineered liquidity point is taken again, does it mitigate anything? Nope. And this whole move happens afterwards. There's no imbalance. So that tells us this is where price must come to. And this order block below, it's an SMT, right? Based on structure, when an SMT is mitigated, it should not make a new higher high. With that being said, it can come anywhere within the range. As per our rules, we just want to follow order flow. If the order flow is intact, follow it. Now you can know specifically that this won't work, and specifically none of this will work, because on a lower time frame, this was the only imbalance above. Again, a higher level of comprehension, but over the next several weeks, you guys will be able to understand. And again, this engineered liquidity was not present on this time frame. All that you could have said to yourself was, well, we had some form of sell side liquidity taken. Now, where's the next high? Well, we know it needs to come above here. So that tells you either here or above. And how would you know this isn't going to work? Because it's at equal highs. So using logical reasoning, when you become more advanced, you'll be able to know that this is the only order block that will work. And then same thing, we have the trap. After the trap, what happens? order flow, right? Order flow to target a new trap. So we're gonna be going over the inducement cycle before the first block ends. So you guys have that set in stone because that is how the algo delivers into POIs and then reverses from there. All right. So now guys, this first block will be one of the longer blocks of today, blocks 1 and 2 specifically. So engineered liquidity, right? Conceptual understanding in the application. So why do we identify and utilize engineered liquidity? Well, similar to the process or to the purpose of inducements in regards to liquidity, the two areas that we care about in regards to the algo as it pertains to liquidity specifically, we only care about inducements and engineered liquidity. That is it. All the other retail liquidity types that you learned, inducement tells you why all those fail, but still be aware of them, but you're not always going to be identifying them, right? We want you to subconsciously be able to process them, to keep your charts clean, to have your retention of the skills very high. And you know, they're areas internal of a range, right? Where price randomly picks up and it does not mitigate anything. It doesn't matter what trend you are in. If you're in sells, if you're in buys. What happens again, you guys can draw these two quick models, is when you're looking at this engineered liquidity point, it first forms after the imbalance occurring, right? So what happens is after your first major imbalance occurs, where price at first internal high, it won't mitigate anything to the left. That's the first criteria. The second thing that it will do internally is it'll oftentimes do this. It'll just sweep something very small on a fractal level. And then what's going to happen is that it'll just start to establish order flow afterwards. So this is what we consider an unsupported move. Very, very, very important. We call this unsupported. This whole move is unsupported because where it originated from, being this high, it does not mitigate anything to the left. So when you see that we have these scale in positions, why we identify this is because they're going to work short term. But what happens is after this low is taken, guess where the first point price needs to come back to? It needs to come back to take out this unsupported move. This is our lovely engineered liquidity point. Again, the algo engineers internal sweeps, causing price to continue until the external range is collected. All these points are important, so make sure you write them down, paraphrase. And again, engineered liquidity forms in the future, right? After this low is taken, it's solidified. It occurs in the future as a result of us completing scale and entries in the past. Again, a higher level of understanding. When you're seeing all these internal lower highs and lower lows created, in the moment, you're going to be like, I know this is engineered liquidity forming. These are awesome for scale-ins, but as soon as that main low is taken, immediately this becomes a target. After it takes out external, engineered liquidity is immediately targeted for the internal of the range, right? And this is what starts to build the wall. The wall, as we just talked about last slide, is where there's no imbalance, right? So engineered liquidity, it is not just a single candle. It is one candle that then is mitigated by other candles, okay? Then there's going to be a video about this. This point of engineered liquidity is so important, and it takes some practice to start to get used to. Even over here, when you're looking for buys, where's your main range? Well, low, high. Where's your point of engineered liquidity within here? All the new students only. New students, please identify where the internal point of engineered liquidity is. Boom, right? Beautiful. So this is our engineered liquidity point, right? Over to the left. This is that first point that'll occur after 1, an imbalance. 2, it won't mitigate anything. And 3, it'll start to mitigate itself to then go higher. So this is where our wall happens. When your wall occurs, that tells you this is the first place that there will be some order block. Now it will either mitigate to go higher, and if it dare breaks the wall, doesn't matter if it's having a pullback, it still needs to come down here. So we're just be looking for sells until it comes down here. So that's engineered liquidity. We'll give everyone about 10 more seconds to copy your notes, and then I'm going to give you guys a quick update about a break. All that price. All right. So now that we have this, everyone, key takeaways about engineered liquidity. Again, I know it's long, but push through some very important things we're going through. All that price needs to do is take out engineered liquidity and reverse. Key point here. This is all that price needs to do. So if you have your point of engineered liquidity here, and let's say you have your order block down here, For an entry, you will always wait for the order block. But one thing we will never know is what order block needs to be mitigated. The only thing that we do know, and the most powerful thing, is where liquidity must get rated. Inducement and engineered. We know that without a doubt in our minds. That always needs to happen. So we know for sure price must come down to here. But what is unknown is what order block. And the order block that I say that we know is the largest one. But you might not be able to identify the largest one in some scenarios. It could be a little tricky. It could be on the 36-minute time frame, and maybe you're only using a 30-minute. 30-minute could be down here. Maybe the 36-minute could be up here for whatever reason. If you identify not the largest order block, that can at times, it can penalize you, right? So what I'm saying here is all price needs to do is take this and then run away. That doesn't mean to enter after it's taken. What I'm simply saying is in some cases where your intuition will really start to develop, as I called it on a trade with students last month, ended up perfect. There are some key points where you have to use your intuition and ask yourself, did I identify the right order block or did I potentially over refine it? If you see price take out the engineered liquidity and you start to see it develop, and only if it is close to the refinement, that you potentially had and maybe it missed, only in that case would I say, maybe I identified the wrong order block. I'm just going to follow, the mitigation after the sweep happened, right? So that is how we need to identify engineered liquidity and properly use it, right? So if this happens, it's always best to wait for the OB mitigation. If it doesn't mitigate the order block, do never have this in your trading plan. Don't just say engineered liquidity taken, I'm looking for an entry. This scenario should happen 5% of the time or less. So always wait for your extreme. But in a case where time is aligned, everything else is looking good, and you have the experience, then potentially consider it. But if it does not, for the next several weeks, do not even worry about it. It's just an important point to have when you're practicing, right? So the order block is lying after engineered liquidity. If an order block is lying at engineered liquidity, AKA right here, if this is given order block lying here, it will not work. We've seen this a couple times with students, specifically on US 30 last month. I had a very convincing decision. It was lined with engineered liquidity. And I knew it and I said, this very well may not work, but I want to try if it does work. I looked at it and guess what happened? We had a small reaction, and then ended up breaking right through. So take it from me, your order blocks lying at engineered liquidity, 98% of the time, 99 will not work. So just completely ignore them. This is one of the most important points to reference right here. Engineered liquidity is the first area within a range that price randomly established order flow, AKA unsupported. All these are keywords you must have. Okay. So when you learn the algo, engineered liquidity won't be appearing up here. Engineered liquidity is the first area within a range. When I say first area, I'm viewing it from a higher low to a higher high. It is the first area after the higher low is created that makes a higher high. It's not the first area as price is coming back into the range. You guys, it's going to depend on your perspective. But specifically, your engineered liquidity lies before. Let me rephrase that. Your engineered liquidity, everybody, lies after your extreme order block. Lies after your extreme order block. I'll give everyone another 15 seconds or so, and we will continue. All right. Okay, everyone. So now I'm just going to host or hold a quick poll for you guys. Would you guys like a 5-minute break for this first? Yeah, I'll give you guys a 5-minute break for this first block. We're not through it yet. 5-minute break, and then we're going to push through the remaining of the first block, and then we're going to have a 15-minute break. All right. So everyone be back here at 11:28 a.m., 11:29, no later than, and we're going to get started and resume block 1. So timer starts now. You guys are free to leave your computers and be back here in approximately 5 minutes. Ziggy, turn on an alarm for 5 minutes. All right, you guys are free to go. Mindful that everyone type a 1 in the chat if you're ready to resume. Finish up block one. We're then going to have a 15-minute break and then start block two, the most important block of today that is going to transform your whole edge and give you a specific plan-by-plan approach for the highest probability trading setups. Who's ready? Who is ready for today? Awesome, awesome, awesome. All right, Antoine, if you can give me the thumbs up whenever we are ready to continue and students are back. If you are there, Antoine.
Nope, you good.
All right. Well, everyone, so this is a video that we are going to come back to at the end of today, permitting that we have time. You guys will all have access to it after the boot camp. It's a 22-minute video where we explicitly talk all about engineered liquidity. But I think with your guys' level of understanding so far, I think we're ready just to go ahead and pass and put our skills to the test. Again, you guys will be able to watch this, permitting that time is left at the end of the day. For those who want to stay, I might be able to play that for you guys. But in the meantime, we have a bunch to go through. So as mentioned, we just took a quick break. Now we're going to go through application, anatomy of the algo, some of the most important things that you're going to finally be learning. And then immediately thereafter, go over a few things additionally, and then go right into our main break and then start for block two, because that's where things are going to be taken to the next level. So let's go ahead and continue onwards and just send a reminder in Discord if you guys are one of those people who want to stay later and watch, permitting there's time, and we'll continue right now. All right. Oh, not video, no video. Skip the video. Okay, now guys, I want you guys to be able to identify the engineered liquidity. So specifically those who are previous students, you guys should know where these areas are. I still want you guys to participate, but specifically wait till some of the new students start to identify first, because we want to have, put their skills to the test, because they're the ones who really need the understanding. So wait until you see a few annotations and then start your drawing. All right. So I want everyone to identify in this scenario, where is the inducement? Specifically, where is the continuation inducement? And again, everyone do what makes sense to you. Where is the inducement that we are targeting right now? Mark out the main inducements you guys see at this moment in time. Where are all the main inducement? And everyone is free to analyze at this point in time. Beautiful, beautiful, beautiful. I love it. I love it. I love seeing it. Awesome job. All right. So if you guys can stop your drawings now, I'm going to annotate on the screen. Beautiful. So your inducements are all correct, right? So we know for inducements, we are just looking at structure. So we have this, and now we have this over here. So now inducement is our valid trading range, right? So we know we have a low, high, higher low, higher high. Now we have a break. So now we can assume after sell side liquidity is taken, we know that buy side needs to be taken. So now our current range, assuming this is broken, where's our next inducement point after this is broken? Everybody, after this is broken, where's our next main inducement? After this is broken, main inducement. Beautiful, right? Because this is a low that makes the new high. So that is our main inducement. Good, 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 right? So let me go here. I'm going to do this. So now our inducement points are this low, and it's going to be now, right, this current high. That's the only relevant structure at the moment in time. Remember, anything in the past is not inducement. It's already structure was already induced. Only thing that is inducement is what's currently making some type of trader believe that new structure is continuing. Doesn't matter if it's continuation or reversal. Now, specifically for the new students, refer to the diagrams in the note I made. Identify all of the engineered liquidity points. So everyone identify all of the engineered liquidity points with a line that you see. Again, no walls, no walls. I'm going to clear y'all's drawings for a second. No walls. Just at this moment in time, everyone identify only a single line of engineered liquidity. And everywhere in the trend. All for buys. Cheeky TC, cheeky, cheeky. All right, you guys, 5 more seconds. There you go, Juma. You a sniper. Awesome. All right, now let's take a look at it. Where is our engineered liquidity? Now remember, engineered liquidity is the only other thing of liquidity that we focus on. So whenever a high, if these are our last two relevant inducement points, we want to identify the engineered liquidity that's both within here and also anything else that it could even be below here, right? So let's identify all the engineered liquidity. Now you're going to learn specific areas where to look, but let's start all the way from left to right. So let's start down here. Where's the first imbalance that occurs? First imbalance is right here. Cool. Where does the first area of a pullback occur after this imbalance? And where does the order flow start after the pullback? Well, notice here, this is that point that price came back to, and then what happened? Price just started mitigating order flow after that. So naturally, this is going to become the first area of engineered liquidity that we still need to take. And that's below the range. Within the range, now let's identify where price randomly picked up. Now over here, this order block was mitigated. Great. This order block now, do we have an imbalance afterwards? Yes, we do have an imbalance afterwards. So this is where engineered liquidity is, right? Now, one key thing in this scenario is that price actually does not create some form of order flow. You're going to learn that in the video specifically why this is still a case of engineered liquidity, but it's not a definition example. So imbalance picks up right afterwards, price runs away. So for here, I'll just put a little line because we'll revisit that in the future. Where's the other areas? Where does price also pick up randomly, doesn't mitigate anything, and starts order flow after? Well, specifically, we see that price has a pullback. This low does not mitigate anything. What happens afterwards? Boom, order flow, order flow, order flow. So this low is the first true area of engineered liquidity. And what does that tell us if this is the engineered liquidity? What is this that lies afterwards? Wall. This is a wall, right? So which tells us because that is where the wall actually stops, right? Here's where it starts and that's where it stops. Notice what we have at the end of the wall. Don't we have an order block, right? But is this order block correct based off of an inducement? And remember, look at your SMT diagrams. We have a type 2 that we're selling above a high. This is going to be SMT, right? Because traders would think, oh, we have a new high. This is our order block. Correct, Matthias. Yes, it is incorrect order block. So now let's identify the other engineered liquidity. Where's the next imbalance? Boom. Well, where's the next area price starts to pick up and establish order flow? This is where price picks up after the imbalance right here. What happens afterwards? Do you see how it didn't mitigate anything to the left? Nope. And then it starts establishing order flow. So this is our next area of engineered liquidity because we have a new wall. So then where is our next SMT then based on this? Everybody, where's our next SMT if that's our wall and that's our engineered liquidity? Juma, Constantinos, Matthias, Juma, beautiful. Awesome, right? This is our next SMT right here. So now based off of this, everybody, based off of this, and now let's say that we have officially collected the inducement. Let's say that we have now officially mitigated, or we've taken out the inducement. Let's say we've already taken it out and we've mitigated the correct order block. I want everyone now to draw for me after, let's say price makes mitigation here, everyone draw for me what the next reactions are going to look like. Beautiful. Scribbles, I like it. Awesome. Exactly. So now based on this, let's see how powerful this is. Exactly. Price will come down, mitigate something. Maybe it could establish, come down, mitigate, come back, and then come down even lower. Boom. So guess what? The whole cycle repeats itself. The build up towards the inducement, this creates the trap. And then guess what? Now we just follow the order flow because we know where price needs to target. And if we know it needs to come back down here, we know it'll come back down to here. And why? Because it's also equal lows. So you can actually push your luck or push your confidence level because these are so close to one another. There's not going to be an order block within here that'll work. I can promise you that. Never seen that happen ever. So guess what? You can really push your luck to here and then guess where the next order block is? Boom, down here. So that means if it wants to come back down here in reverse, it can. And again, in this scenario, that would be what type of inducement? Boom, be a type 3, type 2 inducement where we look to buy below and then target new highs if we wanted that to happen. So the reason we identify all of this is to build a high probability projection, not just based on, oh, here's an order block and it wants to go down. Anyone's blind grandmother can do that, right? We want to understand how to navigate the matrix, how we know where price is going to go, how it's going to get there, because when we can have a whole analysis project with a very high degree of accuracy, guess what? All that's left for you to do is wait for price to look exactly like you want it to. And then your level of confidence is through the roof. Your level of competence by being able to understand where price is actually going is going to be through the roof. So when your confidence level matches your actual competence in executing, that's where effing magic happens. That's where you go to the next level. And that's what I want to get you guys to do. Don't focus on the money. Don't focus on anything. Focus on the skill set. focus on building that confidence, that intuition, that's what's going to transform your trading as a whole and create a huge paradigm shift and perspective shift. Awesome. So inevitably, let's see exactly what happened. Let's see if what we've analyzed happened. Well, guess what? Where are the SMTs? Boom, boom. We had our next one. Where was it? Somewhere over here. Boom. This is where pricing has come. Boom. Let's see if it exactly what happened. Well, magic time. This is the inducement. This is the trap. It mitigated the correct order block. Guess what, everyone? Does everyone see here? This is an inducement, or this is an SMT. Can everyone type in the chat what type of inducement or what type of SMC type this is? Remember, if we mitigate the right order block, what reaction can we expect afterwards? Everyone look at their notes and type in the chat. What reaction, what type of SMT is this? Beautiful. Type 2, guess what? Price pulls back to go where? To our valid order block. After it comes back, what do? Rinse and repeat, baby. Order flow, order flow, order flow. What does price do? Boom, sells all the way down to our SMT. When an SMT is mitigated, what does price come back to? Where do we then look for price to pick up? Mr. Villafuerte. Beautiful. Key point, when SMT is mitigated, it comes back to order flow. That's your Bible right there. SMT mitigated, where's the last order flow? Boom, right there. And guess what? If this is your SMT and you have an order block over here, what does this tell you? What type of order block is this if it mitigates an SMT? If an order block mitigates an SMT, what does this order block become, everybody? SMT, right? It becomes another SMT. When an SMT is mitigated, notice you have order flow going in this direction and now in this direction. You're always going to have order flow converging into somewhere, but the real direction is the one that's not mitigating an SMT. Another key point. That's going to take a lot of experience to figure it out, but I just saved you guys years. So when an SMT is mitigated, this just becomes another SMT. Order flow, order flow. Price comes back. Where's the order flow? Boom, it's left off over here. Order flow, order flow, order flow, order flow. Guess what? After now we take out this engineered liquidity, we mitigate the order block. Where does price need to come back to? We take out sell side liquidity. Now we need to take out buy. Boom, comes back to order flow. Sells after this order block is mitigated. Where's the next area we need to come to? Well, isn't there a whole wall built from here all the way now to over here since all this imbalance is accounted for? Now you know exactly where price is going to go. It needs to come all the way down here next. So it is not going to stop until it gets there. Any pullback that happens, like here, you're just going to focus on a quick mitigation to then break it. And again, that is where magic happens. How price moves, how it delivers. The hardest part is the learning curve. But once you understand, it becomes very simple when you have all the pieces put together. That's where everything will change. Absolutely. You guys will become phenoms, analysts, and then it's time to become beast traders, risk portfolio managers. So then that's where, of course, after price comes here, what's the next area? Boom, it mitigates. And guess what? Pull back to keep selling. This is where the magic happens. When you understand how to enter and your confidence is so high, you're not just going to have one entry. We would love for you to get one entry, but the goal would be to have 2, 3. Again, no more than that, but just to show you the opportunity is always there. Always, always, always. Any move, any direction. When you can properly understand, that's where everything changes forever, right? So after going through this, everyone type in the chat some feelings, emotions, takeaways that you guys are feeling after we just went through all of this. How are you guys feeling after going through this? All right. So yeah, it's going to be a lot up front, but I can promise you repetition is key. Beautiful. I love it, everybody. Awesome. All right. Now we're going to do one more practice example. All right. So we're ready. I think we're all ready in this point. Now, same thing, everybody, but one at a time, right? One at a time. Over here, I want everyone to identify where are the main inducements, where are the major inducements. Go ahead and identify the main inducements. And only that, nothing else, everybody. And once you're done, let's leave it there. Beautiful. Awesome, right? So now let's go ahead and identify these main inducements as you all have illustrated. We can breeze right through these. We know we have a low, lower high, lower low. Where are our main inducements? Above this high, now below this low. We know below this low because we previously took out gas over here, right? So now guess what? After we identify the inducement, I want everyone to now identify the engineered liquidity. Don't draw any walls. Identify all the engineered liquidity. Where did price pick up after an imbalance just within this range over here? Because again, we already broke this. So now we're focused all on this, right? Because we've now collected gas. Now we want to focus all in here. Where's price going to go? So identify all the areas where price picked up after imbalance and created order flow. Give everyone 15 seconds. Engineered liquidity is that first point after imbalance. That ends up being mitigated. Awesome. Beautiful. Love it, everybody. You guys are all on point. I'm going to clear your guys' drawings. Good stuff. So based on what you guys have drawn, your engineered liquidity points start from the low to high. Where's our first imbalance? Boom. This is our first imbalance right here in our order block. Does price mitigate anything? No. Doesn't mitigate anything. That's the first criteria. So, and it artificially engineered itself. Now, is this order block mitigated? Yes. So now that it's mitigated, this tells us sufficiently that this is our first area of engineered liquidity. What happens afterwards? Well, we can clearly see price started to develop some form of order flow. This was mitigated. This is mitigated. This is mitigated. This is mitigated. This is mitigated. So all of this over here is now building order flow. Now we need to ask yourself, where's the next imbalance that happens? Well, the next imbalance is right here. Does this mitigate anything to the left? No, it does not. Does this start order flow after? No, it does not. So is this engineered liquidity? It is really not. This is just liquidity internal to the range. So we're actually going to skip over this because it satisfies one of the two criteria. So this, we'll ignore this. Where's the next imbalance? Boom. Does this mitigate anything to the left? No. Is it mitigated? Yes. So that tells us this is engineered liquidity. Boom. Order flow, order flow, order flow. Price runs away. Where's the next imbalance? Next imbalance is right here. Does this point over here, does it mitigate anything to the left? No. Does it have order flow after? Does it come back to mitigate itself? No. So this is just an internal liquidity point. So it's not engineered liquidity. So on to the next. Does this mitigate anything? No. Is it mitigated? Yes. So now this becomes the next area of engineered liquidity. Moving forward, imbalance. Does this mitigate anything? No. Is it mitigated? Yes. So now this becomes engineered liquidity. And now guess what, everyone? This is where we are. So after we identify the engineered liquidity by asking those two questions, did it mitigate anything? And did it start order flow? It has to do both of them to be an engineered liquidity point. Then we know exactly where the walls are. So the wall, it tells us where not to look. Well, guess what? Anywhere, all between where? All between here tells us, right? That's where the imbalance happened. Tells us any order block in here will not work without a doubt in our mind. It'll essentially, when we see a wall, we expect price to raid right through it, just absolutely drop right through it because there's no imbalance. So now where's our next wall? Boom, over here. So it tells us when price reaches this area, it should just raid right through it. Where's our next wall? Boom, over here. So when price meets, it should just raid right through it, and another wall. So now we've identified our walls. I want everyone with a box tool to identify the SMTs. Where are the order blocks that will lie that aren't going to be correct? And 15 seconds or so for everyone. Should all have 100% right now. Awesome, right? Great. And order blocks, you only identify order blocks that have imbalance. If it doesn't have imbalance, it's not an order block. Great. So now I'm going to clear everyone. You guys are all killing it. So our order blocks now that aren't going to work, again, are the order blocks that lie at the highs of engineered liquidity, meaning here. This is where engineered liquidity ends. That's the opportunity for it to react. We have an order block here. It could react. Order block here. At the end of the engineered liquidity here, we have an order block here, right? That won't work because it ends at engineered liquidity. And then we have this last order block here. This can work, but based on this now, the last thing I want everyone to do, again, first, inducement. Second, engineered liquidity. Third, walls. 4, identify the SMTs. The fifth thing now that you want to do, identify how price is going to move. Go ahead, everyone, with a very high degree of accuracy, anticipate how price is going to move based on taking, damn, well, Marcus, you were ahead of the game, my friend. And everyone, please participate. I know it's repetitive, but that is the point. It'll be engraved in your mind the more you do it. Exactly. Awesome.
One question. One quick question.
Yes.
Could you repeat the order? You say inducement, then engineer liquidity, then SMT.
Yep. So 1 is inducement. 2 is EL, engineer liquidity.
Yeah.
3 is wall. Draw the wall.
Wall.
4, SMT. So you draw
There
where SMTs are at the end of the wall, not where it starts, where it ends. After you have the SMT, the 5th thing to do is the projection. Project how price is going to move. So I'll give everyone 5-10 seconds, write that down, and then we will continue. Again, there's like many, this is just the steps to identifying, how to practice, drawing this out specifically. But notice there's also what? You have your you're building up liquidity towards your inducement. You're trapping. After you have your trap, you identify your SMTs, your engineered liquidity. You then identify your order flow, how price is going to move. And then it's all it becomes, right? That's all that you would expect. All the internal order flow, always going to be the same. So now let's see exactly what ends up happening, everybody. And like we said, exactly as is, right? So exactly inducement taken, engineered liquidity, boom here, boom here, boom. This area was identified, but again, this is not actually engineered liquidity, just internal range. So we have order block here. We're going to have, again, order block over here, order block over here. And notice what happens. They're going to get mitigated just to do what? Mitigated to come back to order flow, right? And as soon as everything is completely mitigated, it's going to have to repeat the whole entire cycle, okay? So this trade actually ended up going all the way down because again, SMT, what happens? Well, you have your SMT back to order flow and price will continue lower. So you're drawing your projections exactly as price is going to deliver. Now, are your projections going to be 100% right all the time? No, nothing's ever 100% right, but you're going to have such a high degree of accuracy and understanding how price is delivering. And then all that's left to do is wait for price to either fit it or come very close and then react according to that. Again, trap, order flow, order flow, order flow, order flow, order flow, order flow, order flow. So maybe price could do this. And then guess what? We now know where we are dropping. So that's all that it comes to, everybody. It becomes very simple once you have the difficulties of understanding where it's going to go. It becomes very simple. Awesome.
Yeah, look, just a quick one, just for confirmation. You said 2 criteria. I want to be sure. For
does it mitigate
liquidity? Does it mitigate something and does it commence further flow, isn't it?
Does it mitigate anything to the left? And does it start order flow after?
Okay, and then secondly, you said SMTs that won't work are those ones that are created at the engineered liquidity, the order blocks rather.
There again, SMTs are
structures that won't work. Okay.
So yes, so yeah, you got it. Those are SMTs, but always follow the diagram for SMTs. All I'm saying is, remember, if you're bearish and you have an inducement here, structurally, your SMT is going to lie here, but essentially on a fractal level, any order, if we're looking to sell, it doesn't matter if the order block is lying up here, here, here. You're going to have all these different order blocks that are left to mitigate. That's why at first, when you learn SMC, you're going to be drawing so many order blocks because you don't know which one. All that you're doing here simply is understanding that any order block that's not structurally supported will cause a pullback. That's it. So that's the answer to your question. Also, guys, write down your questions because day 4, I will be reviewing them. I know that a whole bunch of you guys have all these questions, and I promise you they will be answered over time. We have a lot to get through. So save your questions for tomorrow, write them down, and I promise I will spend all my time to go through all the questions that you guys have. All right. But after that example, we just went through, everyone again, type in the chat. How are you feeling? What's your understanding? 1 to 10. 10 is amazing. 1 is you don't know anything. Everyone type in the chat how you're feeling so far. Love to see it, Marcus. Awesome, brother. 5, 6. And that's expected. We're all over the range. I mean, as long as majority of y'all are feeling like above over 3, 4, I feel very, very confident. All right. So let's get a few more people to see, even if you're a previous student, I want to see how you guys are feeling about this. Eunice, you said in there, and Sean, good. Let's get a few more people and then we are going to continue. Good. All right, everyone. As mentioned, the first block is the longest. We have some very important slides we're going to finish up here, and then that's when our main break of today will occur. So hang tight. This is the time to laser in, and exactly as Antoine said, always room for improvement, right? Every day I learn something. It's nothing really analytically. It's all psychological, but that's where the real sauce lies. So everyone, pillars of the algo reviewed, understanding the why behind price. Again, what is the CBA? What is the central bank algo? Again, it's the algorithm that regulates transactional liquidity between buyers and sellers. ensuring there's an equal transaction loss and gain from a liquidity standpoint by always taking out both types of traders before continuing either direction. This doesn't mean that it's an equal transaction of both buyers and sellers in terms of volume, because there's never going to be that. It's ensuring from a liquidity standpoint that both buyers and sellers are taken out. And how you're going to know which is going to be needed more of? Well, think about it. In order for us to go lower, right? This is our range. In order for us to go lower, we know that majority of the orders are going to be above here. So we have to collect majority of the orders, then target a minority of the orders. Now, you can make a note of that. I'm not going to be going too deep into that, but essentially that revolves around an order book, which tells you everything about liquidity that we do not have access to. Essentially, if you think about where all of the orders are, that is where the first area price must go before then continuing in an opposite direction and just repeating this, right? So we understand how the institutions are accumulating their positions fractally. And again, they're accumulating their positions after inducements, right? Because what happens when you hear about order blocks specifically, everybody, is, years ago, 3 years ago, when I was really starting order blocks, 5 years ago, when I first heard about them, it's always like, oh, they need to sweep liquidity, right? And cause a move in the opposite direction. Where's your order block? It's going to be down here. But where specifically are institutions getting in? Well, specifically when it comes to order blocks, they're the first sellers that take out these stops to the left. So they're injecting all of the orders to come down, aka a sell to buy. And then they're also injecting orders at the very low to initiate this run. So they're both getting in here to start the order block. They're also getting in at the very low to cause price to go in the opposite direction. So while they're making money in this direction, they're in drawdown over here. So then they just have to rinse and repeat the process of rating stop losses down, aka collecting money over here to break even on their first area to then reverse price to make money again. So they're making money all ends, everywhere. Hedge funds, institutions, constantly in trades both directions. That's how they make money, right? Too advanced, too sophisticated to go over right now, but that's essentially what the central bank algorithm is always doing on every time frame. It's not like they're just entering one position. They could still be, right? What's happening is, guess what? They're funding this buy over here to take out these sellers. They also funded the sell to take out, I'm keep reversing buy side and sell side liquidity. But they're taking out these liquidity in order to then rinse and repeat the process. So they're getting in buys here. They're also getting in sells over here. And on a fractal level, they're rinsing and repeating the exact same thing. So we need to identify the footprint of exactly how they're manipulating price to get to, right, these areas. And they're everywhere in the market, right? Every move that happens is regulated by the central bank algorithm. It's not just about the manipulation that we're focused on. We're focused on the regulation within the manipulation. And you're not going to hear anyone talk about that besides us. You need to understand that regulation, there's always homeostasis. Yes, there's things that are always unfair, but there's always balance to the matrix or balance to the force, right? As you say. So we need to understand how the institutions are accumulating their positions and only getting in at the initiation point of the algo and the transactional point. What is that? Well, you guys are going to be learning today, especially as we talk about the anatomy of the algo, but specifically there's an initiation point that starts the algo, and then there's a transactional point where the checks and balances comes into play to ensure both stop losses on both ends are being collected in order to then rinse and repeat, right, the process over and over and over again. It becomes algorithmic. It's not SMC. It's not basic BS. It becomes very in-depth, as you're going to realize in the next few slides. It's about balancing liquidity to liquidity. Spoke a little bit on that now. In order for price to go anywhere, say this all of the time, you need to ask yourself these things. One, where is the gas that will cause price to get to the destination, right? You always need enough fuel to get to your destination. And the second thing that is of equal importance is what is actually going to cause price to go there. Just because you collect enough gas doesn't mean that price is ready to reverse. This just tells you you've actually fueled up to go to your destination. What's going to actually cause price to go there now is going to be an order block. Order block blocks orders, right? It's going to block orders so we can go in the opposite direction. Without this will not work. So you're just going to be fueling up until you get in your car. And once you get in your car, that's illustrated in the form of an order block. Now you've put your gas in the tank, right? You're at the gas station, you put it in the tank. You're only ready to take off once you go back in your car. Your order block is your car. So once you go back in your car, you're now ready to resume your trip. It's always about regulating manipulation continuously and fractally. Again, to have a very fractal understanding of it, you first need to be able to apply it on a larger level, and then you start to really navigate the matrix, but it takes a lot of experience to get to that point. So now we're going to have a deeper dive and a deeper understanding of this. Again, after we go through all this, it's probably be about 20, 25 more minutes or so. That's where we're probably going to have 15 or 20 minute break. I'll leave it up to you guys because today is the most important day of the bootcamp. Pillars of the algo explained in review, right? Inducement. Why is inducement a pillar of the algo? Because it's about exchanging external range liquidity, and it's the initiation point of the algo. It's the initiation point of the algo. That is what inducement is. You have your SMTs. Why is SMT a pillar? Again, it tells us where the incorrect OBs are as they are accumulating stop losses in the opposite direction. If this is where the algo is initiated, right here, and everyone's looking for an order block over here, where's everyone's stop losses? Everyone's stop losses are above here. So if this is the initiation point, the transactional point needs to be where all the other stop losses are collecting stops. So now we know price needs to accumulate stop losses here, meaning, oh, we have a double top, we have a trend line, we have whatever it is, more stop losses are put above here. So by building more liquidity, that's going to be the fuel for the next move that happens. So SMTs, accumulating stop losses in the wrong direction. Engineered liquidity. This is what we refer to as the transactional point of the algo. Very important, internal transactional point of the algo. This is the point where price then establishes checks and balances of liquidity have been maintained. They're at homeostasis. Now we are ready to reverse in the opposite direction, right? And of course, the last two key points is going to be based on order flow and just order blocks in general. They show us where and how the institutions are accumulating their position at highs and lows that start every move, absolutely every move, right? It's not just on the 4 hour, the 1 hour, the 5 minute, it's on the seconds, it's on the 12 month, it's everywhere all in between. So if you know order blocks, which tell you where they're getting in, and you know exactly where everyone is losing, you already have the blueprint. Now it's just to put it together in the most concise way. All right. Now, everyone, let's go ahead and take a deeper look. So now the fun stuff. This is what everyone has been waiting for. The anatomy of the algo. Who is ready for the anatomy of the algo, everybody? Type a 1 if you are ready. Type a 2 if you can't wait. Gabby's ready. Ogden's ready. Chuck Mano is ready. Mr. J. Wilson's ready. Is Chabon on here? Billman, that's all right. All right, let's get right to it. Anatomy of the algo, everybody. Viewing liquidity ranges like a mastermind. This is not algo structure. This is understanding the checks and balances of liquidity. Let's get right to it. I'm going to give everyone 30 seconds or so to draw exactly what we see here. 30 seconds. Once you're done drawing that, type a 1 in the chat, please. And you don't have to make it exactly perfect, but try the best you can. So the most important things. Again, once you are ready, type a 1 in the chat so I know that we are ready to continue. Mr. Luciani, Mr. White. Everyone, 15 more seconds or so, and we're gonna go right through it. All right, so the anatomy of the algo. What we are viewing to the left is a bearish range, right? Bearish range. What we know about our ranges, right? What we know is that each range has a main leg and an internal leg. You're going to consider the main leg, again, every main leg is just going to be a higher time frame internal. If this is your main leg on the 5 minute, well, guess what? If this is your 15-minute leg, it's just going to be an internal leg. So it's fractal, okay? So this is your main leg up here, your main leg, your major inducements rather, main, major. What you see here is the anatomy of the algo. So what happens is your initiation point of the algo in a downtrend is right here. Whenever an inducement is taken, aka whenever price traps an inducement, this is what we consider the initiation point. So this point being,
Hey Griffin, we can't see your drawings.
thank you, sir. So this so this right here, this is our main leg, major inducement. This point right here is our initiation point. So in a downtrend, when we're previously bearish, doesn't matter if we're going to be bullish, whatever in the future, this is your initiation point. This is what starts the algo for the checks and balances of liquidity to come into play, meaning this is the first point that there is unequal distribution or unequal liquidity. We have to take out both traders in both directions. So assuming in this scenario, right here, we mitigate an SMT, right? So I would still put here represents SMT or true OB. I would still put this here, but we're going to focus on the first example. We're going to focus on SMTs. When your main inducement, this is your main inducement, when it's rated over here, this is the initiation point of the algo. This tells us now that sell stops have been collected and an SMT has been mitigated. We know that SMTs come back to order flow, or at least some form of internal structure, right? So when an SMT is mitigated, we know that price won't go higher, right? We know it's going to be respecting the range. So when a stop loss is collected externally, we then have to go internally to collect the gas, right? So if we're bearish, if this is our new destination in the future, we need gas to get there. So every individual high is going to have our gas above it. Every individual high is going to have gas. This high, this high, this high, this high. We need to collect the gas to go to our destination. But only 2 points have relevance, as I've been mentioning this entire time. Inducement and engineered liquidity. Those are the only 2 points in any range that we actually care about when it comes to liquidity. So when it pertains to the algo, after this first external point is created, after it's collected, right? This is the first point price must always come back to. It must always come back to here. Why? Well, because as soon as sell stops are collected, this is going to be the first area internally where buy stops are going to be above, because internally you have your lower high, lower low. If this high is broken, people say, oh, it's a BOS, it's going to reverse in the opposite direction. We always know in any range, price must come back to here. Always, always, always. It's not, oh, it can sometimes, it can 95, 100% of the time, this will happen. As soon as price mitigates an SMT or a true OB, doesn't matter, it must come back to here. So based on your SMC types, notice here, you're going to have an SMT here. This SMT will not work. It will not work. So if you see it and you have a pullback, just focus on buys to break the inducement. So this is our first internal point within any range. If this is your internal structure, this first point is always going to be your inducement. Price always needs to come back to here, always. Above your inducement, right? Your next liquidity point that you care about is right here. This is your engineered liquidity point. Your engineered liquidity point, again, is that first place, that first area after your lower high that has imbalance, and it's where order flow starts to pick up, which inevitably creates the wall. Because this move over here, it mitigates, break and retest, will mitigate some form of higher time frame order block, or it will mitigate nothing. This is where price at the maximum should return to, right? This is what we call right here. Case sensitive, I'll just say for what it is right now. This is the transactional point. This is the TP, not the take profit. This is the transactional point of the algorithm, meaning at the very minimum, we need to come back up to here to take out sell stops, take out buy stops, and then we can continue. This is what must always happen. It must come back to your inducement point. Doesn't mean it's always going to come and mitigate. It could go higher. So your inducement. Now, very key point. What separates your engineered liquidity and your inducement is your decisional. Very important, is your decisional. Now your decisional, it doesn't have to be at the end of your engineered liquidity. Sometimes you might not have any. Sometimes it could just look exactly like this. And guess what? Well, if there's no engineered liquidity anywhere, and this doesn't have order flow after, right? Well, then this is your valid decisional here. That's your extreme. It can look like this, or it can look like this. there's not one size fits all, but the logic will always remain the same, right? So in this scenario, hopefully you guys can see why this would make sense. Do you guys see why the cell in this scenario would make sense? I would draw this exact scenario for cells. This is one option. If you mitigate an SMT, this is why a decisional would work. Here, give everyone 5 seconds to draw this. And just draw a dotted line to illustrate 2 examples based on an SMT. After an SMT is mitigated, the next thing that can happen, well, it doesn't always have to mitigate an SMT, right? It can actually do this. Right? The next thing you can do is it can come up to here and they can do this. Well, at this point, what happens? Where's our wall now extended to? Here to now all the way over here because everything is efficient. So maybe it could come down here and then we can go all the way up to where now? Where can we potentially go up to based on the wall? Well, we know that maybe an SMT could be lying here and then it can come up all the way to our extreme to take out our engineered liquidity. From here then, same thing. This is our inducement. Here's our SMT, order flow to drop. So do you guys see how both scenarios make sense? Whether it's an extreme mitigation or it's a decisional, how you're going to know which one is going to be based on the SMT. Your SMT is lying out a bunch of liquidity. If it just equal lows out of the WUPA, well, you can assume the decisional is going to get mitigated. If your SMT looks something like this, and it sweeps liquidity, well, in this instance, you can expect it to take a little bit more liquidity to then end up actually breaking it. All right, I'll give you guys 10 more seconds and I'm going to clear these drawings. All right, can keep pushing through, y'all. We're almost through. So after taking out external lower lows, right here, price must return internally to collect the gas above 1. This is our transactional point. All internal lower highs are the gas, but we only care about 2 points, the inducement and the engineered liquidity. Everyone type a 1 if you're ready for the buy model now. All right, we have 9 people out of 37. So again, let's get, half, let's get 10 more, and then we will continue. Again, we got a lot to go through today, y'all, so. All right, great. So now let's go on to the next portion. Beautiful. Oops, nope. Go through the next one, right? Now we're going to be looking at buys, right? So now buy scenario. Well, and again, we didn't go through the SMT on the other. Essentially, all that I was getting at over here was just right here. If it mitigates an SMT, it'll just come anywhere within the range, right? It'll come here to drop lower, or it'll come here to drop lower. If we mitigate the main order block, if this is a true order block, remember, where's your SMT now? If this is your main order block, if we're bullish, this is your main order block. Where's your SMT now? If this is your target. Anyone know where the SMT is if this is your main structure? Beautiful. Marcus, Sean, absolutely, right? Because if this is your internal, now this becomes your SMT. So it's still the same thing. It'll still fractally come here. But guess what? This is your SMT. I'm just going to end up breaking it. So again, there's many variations, but again, still an introduction. Got to treat it as so, right? Now buys are the same thing. Your initiation point of the algo, right, is always going to be whenever a high is taken. As soon as a high is taken, the first point price always must come back into is this first internal high or low. So everybody get in the habit of always identifying your main and internal structure. I don't even care if you think you see it. Mark circles, mark highlighters. Always do that. It's going to make everything very clean, very clear, and you're not going to get confused ever. Just doing that will transform your confidence as a whole, right? So after taking out your external high, the first point you need to come to is your internal low. So again, if you mitigate an SMT, that means we're still bullish, right? So then again, SMT, we can come here to our decisional. From our decisional, we can just go higher. It doesn't need to. Again, if this is an SMT lying at a whole bunch of equal highs, it'll just come to your decisional to go higher. It's already collected the gas it needs to go to your destination. If your SMT looks like this, it actually takes liquidity Well, it can give you a much larger reaction. So in this case, you're going to expect more liquidity to be taken, which is going to lie at your engineer. So in this scenario, it can just do this. Oh, your decisional could be mitigated. And then it could do something like this. Now, following this, if we're bullish, right? SMT, we're looking at something like this. Well, now what? Well, as soon as your extremes collected, liquidity is taken. Where's the first place price needs to come after this is taken? Where's the next place stop losses are going to be for sells, right? Next area for stop losses is going to be up here. So now we know it needs to come up here, right? And that's still the same thing, the build up to the inducement, to the trap, and then just following order flow to break. Always going to rinse and repeat this whole cycle everywhere. And build up, trap, reverse. Whenever you see a structure point, know the inducement cycle. Right? So that is when we mitigate an SMT. If a true order block is mitigated, right? The true order block is mitigated. So you mitigate the correct order block, and maybe we are structurally bearish. Right? Well, we're inducing buyers. We know over here is going to be our SMT. This is our SMT. What do we do? SMT back to order flow. And then what do we do? That means if this is the true OB, all of these, this is still decisional and extreme, but they're just going to be SMTs. Right? So if a true OB, these are SMTs. That means we're structurally bearish, we're targeting new lows, and then we're just going to be following the trend to go lower. So these two types of setups are, they're not two setups, they're multiple in one, but it's your key. And this isn't the cheat sheet. The cheat sheet is what combines everything for the highest probability setups. That's in the next block, how you can instantly start to see the same setups every single time with a high probability ranking system that's going to keep you accountable. So when everyone is done, type A1, and thereafter we will finish up the section, and then I think we'll actually go toward the 20-minute break. All right, we got 10 people out of 37. Let's get half more, and then we will continue. Government participation is not requested, it's required for this. It's going to help everything go so much quicker. So let's keep it going, and we on game. Perfect. All right, we got half people. Right to it. Beautiful, beautiful, beautiful. All right, everyone. Now, the epiphany, right? What we've been talking about. Let's think about it. This is all that we need to view price. Everything that we need. We have our main structure, our main leg is always going to be our destinations, always going to be our destination. So after structure has made a leg and we created a destination, now we just need gas in order to go to our new destination, which is a larger gas station. It's always about a lot of gas, a little gas. Little gas is just going to allow you to go to the main fuel up spot, right? So these gas points, what types of liquidity, everybody? What type of liquidity do you think is going to be lying at these gas stations, as you can tell? Two types of liquidity. The only two that we just talked about in the previous slide. Exactly. IDM and ENG LQD, right? Only two things. So we know we always need to go above the transactional point. We take out sells. We now must always come back up to here. Must. After we collect this and we know we're targeting here, what's happening is on our road trip, we're actually passing gas stations along the way because we don't need to fuel up. We're just trying to go to our destination. As soon as we get to our destination, then we have to backtrack. We have to go back and we have to fill up our gas, and depending on how much gas we need, depends on where we want to go. It's not just about, targeting new lows. It's about what's to the left, right? If we're all the way down here and this is where we need to target, you better believe there's going to be gas stations along the way. And the further away we are, the more gas that we need to collect. And the closer we are, the less gas that we need to collect. So above every high and every low, there's going to be liquidity. The first gas station, the first gas pump, whatever you want to call this, your jerry can, this represents your inducement. Your second one represents your engineered liquidity. If you take out your engineered liquidity, you're going to have a much larger move. If you take out, because you're collecting not just the engineered liquidity gas, but you're also collecting the gas over here. If you're only collecting the inducement gas over here, right, you're not going to have as large of a move. Compare it. You went down decently far from here. But if you collect both, you are going to be going much farther, much further, right? So take a second, draw this example, put little cans, gas stations, and even if it conceptually makes sense or you think you got it, I would still always reference this example. Took me some time to think about it, and it really, really helps when you could start thinking about liquidity, which is fuel for the markets. Think about it everywhere, above every high, below every low, and it's just going to start to really transform your understanding as a whole. All right, once we have everyone in the chat, type a 1 that you're ready to continue, then we will go on. On what we almost to our break. Now let's walk through this together. Based on what we just did, right? We're not projecting a new move to happen. We're rather marking out what has already happened. So the first thing I want everyone to do, again, we're not projecting a new move. We're using what has already happened, utilizing the algo, the structure of the anatomy of the algo to actually practice how to apply it. So the first things I want everyone to do, based on everything that you already see, mark out your main or your main leg inducements. What is the obvious structure points? Go ahead and mark the structure points out, the obvious ones, and mark out your main inducements for those. Everyone start. Again, the sooner everyone does it, the sooner we can continue. Even if you think you're a beast, see it. Beautiful. All right, all right, all right. All right, I'm gonna clear all drawings. Great, great, great. Beautiful, right? So now I'm gonna clear all drawings in 3, 2, 1. Awesome. So what is the main leg? What is the main trend? Well, we see that we have generally some form of low, lower, high, lower, low, lower, high, lower, low, lower, high, lower, low. Beautiful. We want to figure out specifically why this whole sell-off created. So the first thing we identify is where are the higher time frame inducements, the main leg, or where are the destinations? Well, based on our previous point where structure was, right? If I'm going to clear this, make this a little bit neater for everyone. Right? Based on this, you guys marked it all correct. The last structure point was main inducement here, main inducement here. So this tells you this is where the main liquidity is above the range, but it's also your valid structure range because it's lower high, lower low. So depending on how do we know if this range is going to be broken, what's going to tell us if this range is going to break or not? Can anyone tell me how we know if this range is going to break or if it's going to be respected? Mr. Villafuerte. Anyone? Mr. Villafuerte, que más fuerte, las otras personas. Beautiful, right? So that is what we are looking for. How do we know if this range is going to be respected or if it's going to be rejected? Is based what's on to the left. So if an SMT was mitigated, like we just talked about in the previous slide, if an SMT is mitigated, that means the range is going to be respected. Again, levels and levels to this. It's a lot to understand, right? Or comprehend, always be simultaneously aware of. So if an SMT is mitigated, that tells us the range is going to be respected. So let's say an SMT is mitigated in this instance. Let's say this was an SMT to the left. Now what we want to identify, everyone for that matter, is the next thing. After we take out external range liquidity, a lower low, where is the first point that price needs to come to? Where's the first point? Again, how do you know the first point? You have to know the structure, right? You can't just mark a high and call it a high. You got to mark the structure. So I'm gonna give everyone another chance. Clear viewers drawings. Where is the first internal point, internal structure wise, where price must come back to? So now, do you guys see how your answer changed? If you do, even if it's obvious, it might not be as obvious as you think. You always need to mark properly your internal structure. And whoever marked this down here, I applaud you. This is what everyone needs to get in the habit of doing. Whoever marked this, Trevor, of course, that's what everyone needs to do. Identify where this first happens, so then you can mark the internal structure. If you don't do that, you're not gonna be able to mark the inducements properly, right? So here, this is our main leg, right? Our main cells that we know. Internally within, we're gonna have this. We're going to have, I mean, it doesn't matter where you start, high, higher, low, higher, high, higher, low, higher, high, boom. This is where price first shifted. make it obvious, right? Where's the first pullback that we see? Low, lower, high. Where's the next lower, low, lower, high? Lower, low, lower, high, lower, low. So where's the first internal point? Boom. That is where we know price must come back to. It must come back to here, right? So this is our internal inducement. And what type of inducement is this, everyone? Type in the chat. What type of inducement is this? Everyone, don't follow the leader. Say what you think. Is it type 1, type 2, type 3? Type 3, right? It's a type 3 inducement. So now that we've identified our type 3 inducement, where is our engineered liquidity? I'm going to clear this. Give me a second, y'all. This is our inducement. Where's our engineered liquidity? There's two questions. Where's the first imbalance? Did price mitigate anything? And did it start order flow? Boom, boom, boom. Awesome. All right. So clear y'all's drawings. Let's take a look at it. Take a look at it. Here, where's the first imbalance within this range? Boom. First imbalance. Does this guy mitigate anything to the left? No. Does it start order flow? Is it mitigated? Yes. So because this didn't mitigate anything and it started order flow after the first imbalance within the lower high, that is our point of engineered liquidity, everybody. That is our point of engineered liquidity right there. So this is where price should ideally come back to. Now that we've identified our engineered liquidity, and now that we've identified our inducement, I want you guys to identify for me, where are the correct order blocks? Where's the decisional and where's the extreme order block? Look at your drawing and you guys will know it's the exact same. Great. So now we can clearly see in this scenario, we clear guys' drawings. Boom, clear drawings, boom, right? Your extreme order block in this scenario is right here. Right? I'm selecting both of these because yes, you have this, but also this down here. I'm just practically speaking, this is a higher time frame order block. Just go with it for now, right? Now, where is your decisional? This is your decisional. Can anyone tell me specifically why this decisional might not work? According to one of the liquidity types, not inducement, not engineered liquidity, but why specifically, what types of liquidity, retail liquidity, tells us this won't work? Eunice got one of them. Zane got one of them. There's one other key type. I think Ahmed found it. Trevor found it. Bingo. I was waiting for you, Ahmed. Exactly. Right. So the one reason is because it's lying at trend line. Lying at a trend line. Doesn't matter how you draw the trend line. It's lying at trend line. We know trend lines need to be broken. That first point, always. Also, what other type of liquidity? Whoa, 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 whoa. Break and retest, right? Or key zone, however you want to call it. It's all the same thing. Used as a support, used as a resistance, support, 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 resistance. You see an order block lies at key level, no sir, no ma'am, you ain't taking this. Never ever, right? Always look above. So for those reasons, that is why this order block is not valid. It's always important to be aware of them. And again, for this reason, if this isn't a decisional, that tells us this is an SMT, pull back to go higher, and then what's the projection that we expect, right? Even after we have this, what do we expect? Well, price go up here. Where's now the engineered liquidity within this range? Can anyone tell me where's the engineered liquidity? It's the view for it there. Got it right? We just fast today. Right? Exactly, right here. Where's the first imbalance? The first imbalance is right here. Stop drawing, right? First imbalance is right here. Boom. Candle. Does this candle mitigate anything to the left? No. Does it start order flow? No, it is not engineered liquidity. Engineered liquidity is not one single candle. So let's go to the next imbalance. Where's the next imbalance? Boom. Does this candle to the left mitigate anything? No. Is this candle mitigated? Yes. So this is the point of engineered liquidity. So now we have an idea of how price is going to move, right? It can go up. It'll come all the way back down to here. At this point, maybe move something like this. Again, building up to our inducement, to our engineered liquidity, trapping, and then following order flow thereafter, of course, with all of our SMTs along the way. And exactly what happened, you can clearly see those dose, right? Order block, extreme. This is our minor if this is even another time frame inducement. Where is it? The SMT? SMT. What does SMT come back to? This order block does not have an imbalance. There's a wick, right? So that tells us in the 4 hours, so in a different time frame, we're going to have an order block elsewhere. Okay, so order block could be here, it could be here. Who knows? Not us right now because we only have one time frame. SMT, back to order flow. What happens? Price then starts going lower. Oh, here's imbalance. This is our extreme. Here's our decisional. Type 3, just be learning about. Order flow, order flow, order flow. Price continues down. It's the trap, the mitigation, the order flow reversal. I'm hammering this in your head because it's always the same thing. It doesn't matter if it's this high getting taken. It doesn't matter if it's this low. It doesn't matter if it's this high. Order flow, order flow, order flow. Always the same. All right. So based on, oops, I got to show you guys this. And that's right exactly as is. Again, this is not an engineered liquidity point. This was made several months ago. The actual engineered liquidity point is here. This is our internal inducement. But this, again, is on a fractal level. So again, within this range, some people said this is the inducement. That's fine. You know, this could be the internal of this. It's all subjective, but it doesn't change the fact that we still had everything exactly as is. And then this follows order flow. This was, you know, the extreme. This was a decisional. Decisional ended up being mitigated. So the next extreme needs to be mitigated. You guys will be learning about this. But again, going at a relatively quick pace because I tend to want to explain a lot because there's a lot to understand, but it's not going to happen in 4 days. Okay, so how is everybody feeling after that? How is everyone feeling? I know it's a long haul. Blessed. God did. RIP to my brain, right? It's a lot. I love you guys are feeling awesome. You guys should feel like butter. Hot, ready to spread. Money on the table. All right. So understanding where price is in the algo cycle is essential. When you know where in the cycle price is, you then know how the algo will deliver. Let's review the most important questions to navigate the matrix. So the last 3 slides we're going to go over real quick. And these are the questions you need to write down to understand how to properly navigate the so-called matrix, right? Exactly. Awesome. No, you did not welcome yourself to the matrix before. You're now escaping it. You've been inside of it the entire time. All right. So first things first. 3 things you need to understand about price as a whole. The first thing you need to understand, where price currently is. You need to understand where in the algo cycle price is to determine what it needs to do. So everyone, write down these questions. Again, paraphrase, don't write word for word, but paraphrase. While you're doing that, I'm going to draw something over to the left. Right. So ask yourself, you need to ask yourself, what is the higher time frame or the main trend? Where's the main leg, right? What did the swing points of each range mitigate to the left? Arguably the most important. Is order flow intact? Did price recently trap a medium or major inducement? Meaning, did it liquidate, right? Did it induce, take out the inducement, creating the trap? So did it recently do one of these 2 things? What wave is the higher time frame based on? The internal structure. Are we in a pullback or a continuation? So here to the right, I'm going to illustrate what I'm referencing. So first example over here. Let's say that this is where we currently are in the trend. Let's say that this is where price currently is. Well, before just looking here, you have to understand what price is doing to the left, always. So over here, first question you have to ask yourself, what is the main trend? Maybe you're bearish in this example. So the main trend sells. Boom. Next thing you need to ask yourself, what did the swing points of each range mitigate? Effing huge. Please remember this. Again, swing points. If you have a lower high and a lower low, what did this lower high mitigate to the left? Did it mitigate a valid order block? Meaning that it mitigated a decisional or an extreme to go lower? If it did, that tells you order flow is intact. So that means your high probability order block is over here. If it did not mitigate anything, guess what this point becomes now? Anyone? If this does not mitigate anything, what do we think that point becomes?
Liquidity.
Exactly, right? It becomes liquidity because what happens is if it doesn't mitigate anything, and this is the real order block, guess what? This becomes an inducement. So if it mitigates something to the left, expect the range to be sold within. If it does not mitigate anything to the left, well, expect that thing to be broken. Understand forward flows and tax is important. It tells you your high probability points of interest. Did price recently trap a medium or major inducement? Well, this is our new structure, and we trapped a medium or major inducement, which we clearly just did. That tells us we've collected the gas. The next we have to ask ourselves, what did we mitigate to the left over here? If we mitigated an SMT, guess what? This ends up following a type 2 SMT example, where we look to sell where? We look to sell over here, or type 1, type 2, not remember which one it is. We look to sell over here. If this mitigated an SMT and we're bearish, well, guess what? We're just going to be using this to come higher. So what wave are we in? We need to figure out, if we're analyzing the charts, are we down here where price currently is before we get to the SMT? Have we already reacted to the SMT and now we're on the way up? Or have we already mitigated the order block and are we over here? Or are we now resuming to then continue here? There's 4 phases to always be aware of. You're either at the end of a previous trend, you're either starting a new internal trend, either coming to the high to then resume the internal trend after the pullback, or you're continuing the internal trend to target the higher time frame. You're in one of those 4 phases. You're either in the markup or the markdown. And for those who do know, don't know, there's going to be, and again, I'm not teaching this, but there's going to be an accumulation. For those who do know Wyckoff specifically, there's going to be an accumulation here. There's going to be a reaccumulation over here. You're going to have your distribution here and your redistribution over here. Hola, Cecilia. I didn't know you've been on the whole time. All right, so this is how it's always going to deliver. Figure out what phase price is in, so then you know how it's going to deliver in each phase. If it's in a pullback phase, you're not going to look for sells till it comes up here, right? So that's what you have to understand. All right, I'm going to give everyone 10 more seconds or so, and then we're going to go on to the next vital thing to understand. First, where price currently is. All right, let's go on to the second one. The second thing you always need to understand. How will price get there? No, this one, oops. Let me go to here. Oh, I skipped a slide. Where is price targeting? After you understand where price is and the whole cycle, if this is where price currently is, right? Now I need to understand, well, where is price targeting at this moment in time? Is it, if it reacted from an SMC, and this is your order block, and this is where you are currently, you know it's going to target here. If this is where price currently is, over here, and it's in your order block, right? It mitigated an SMT over here. This is your correct order block. Where is price targeting now? It's going to be targeting a new low, right? So now you know where it's going to be targeting. So first thing, where are you in the whole cycle, right? Where are you? And then the second thing you need to ask is, where's price targeting based on where you are? Maybe you already mitigated and this is where you are currently. Where are you targeting? You're still going to be targeting a low. So what is price targeting? Again, write down all these questions. This is your little key to understanding how price is going to move. Navigating the matrix per se. Are we targeting main structure, right? Are we targeting a main structure? Are we targeting internal inducement to mitigate? Are we targeting something over here if we're buying to mitigate? Are we targeting extreme or decisional order block? Are we targeting engineered liquidity if we're buying, right? We might be targeting over here to buy. Are we collecting internal inducement gas to then target a higher time frame, right? Are we targeting here? Are we targeting in here? Have we already collected external inducement? Maybe this is where we are currently. Have we already collected external inducement destination? And aren't we now ready to target internal liquidity? So these 3 sections are everything. Like this next slide after this is all the questions you need to ask yourself to understand where in the matrix you are, where you need to go. And then the third and most important thing is, if you know where you are and you know where you need to go, the last thing to figure out is how you're going to get there. And this is where building the roadmap comes into play. So I'm going to clear this. And the last thing is, how will price get there? Now you understand where you are. You understand where your order block is. You understand where you are. Now, how are you going to get to your destination? How are you going to get to here? Well, price will need to take out internal inducement to target an external inducement. In order to get to your destination, again, it doesn't matter where you are. If you want to go up here, what do you need? You need to collect gas. So you're either going to be buying below here, or you're going to have some form of internal inducement that you're going to be looking to buy below. You could be going here, then to come up here, right? You could react from an SMT for a pullback. Maybe you come here for an SMT for a pullback, react from SMT to a pullback, to then maybe mitigate some form of order block to then go to where you need to go, which again, still ends up being a type 2. I'll let you guys write all this down. I can elaborate on all of these points, but understanding that this is where you're identifying the gas stations that will cause price to get to the destination. This is what true logical trading looks like. And you guys are the 1% of the 1%. You guys are the only people that know and will have the highest degree of understanding with all these concepts, right? It's not like they're all out there for the public. It's not. Order blocks, sure. But guess what? The majority of people who use those do not succeed because everyone just focuses on the analysis based on rules that is not logic based in the eyes of institution, logic in the form of retail. But this is still a baby step. The real mastery comes psychologically. So everyone type 1 in the chat once you are done writing this down, and we are finally at our break. So type a 1 and we will go, and I will press the break slide, and I'm gonna have a quick poll for you guys. Yeah. I can break myself. All right, everyone, great. And again, this is just at a forecast little hint. This is something over the next couple of weeks. We're really gonna be refining and making a whole dichotomy for you. This is where you are. This is where you want to be. Making a whole list on how to get here based on whatever unique area, wherever you are, and price. So excited for that in the next couple of weeks. These are questions you guys need to ask yourself while going through the algo. If you have all these questions, you have every aspect of it covered. All right. So now everyone, in this section, you guys have learned way more than just this, but again, the proper application and purpose of inducements, how to properly navigate higher time frame, lower time frame, liquidity, how to map the whole algo, mastering engineer liquidity, the transactional point, developing an algorithmic mindset with derived intention and purpose. What we just went through was an algo mindset. Always purpose, reason, purpose, reason, purpose. Building your whole plan around logic and intention, priceless. The final steps preparing you for algo mastery, everybody. So before we go ahead and go to our 15-minute break, everyone, I want to ask you guys in the chat, how is everyone truly feeling so far? What is something today that really clicked for you? And then afterwards, everyone can go. But I'd love everyone to say at least one thing. After we do that, we're going to have not a 15, but we're going to have a 20-minute break because it's been quite some time. So everyone type in the chat one thing that they loved, take away a new eye-opening perspective, anything. Gabrielle, I'm surprised how you know what I'm saying, bro. Solo speak Espanol. Appreciate it. Thank you, Nishan. All right, everyone. Well, with that being said, thank you guys for your feedback. I love seeing that. It helps me know, where I'm doing great, what other things I need to work on. So I hope everything has been clear to this point. Again, just the baby steps. The repetition afterward is going to be the key. Exactly as Craig said, as I'm saying that, repetition is the name of the game. You have to do it until you know it like the back of your own hand and you dream about it because you know it and you see it everywhere, right? So with that being said, everyone, thank you guys for your feedback. We are now going to start our 20-minute break at 1:25 p.m. EST, 25 minutes as soon as I end this announcement. That's when we'll be back. So 20 minutes, 1:25 p.m. and come ready for the remaining blocks of the day. You guys are free to go. Join back and I will send an announcement when we are ready to resume. All right. Thank you guys and see you guys shortly.
Is what makes you special. You spend your whole life trying to conform.
Habit, sort of a pattern, you are going to feel like an imposter until you push through that clenched up moment.
Waiting room. All right, Griffin, ready to go. We're good to go.
All right, just one moment and I'm ready to roll. You know what, 20 seconds and we will get started. Sucks. All right. So yeah, everyone, I know you guys just had your break. You should be all good, refreshed, ready to go. Key takeaways. Again, how's everyone feeling so far? I think we should all be feeling good, ready to go into the nitty-gritty section. Good. All right, awesome. Now, all right. Okay, awesome. Love it. All right, everyone. Now we're going to be introducing a brand new section, and looking at the time, during the break, I got to cut out some things that we will have to review tomorrow. As mentioned, day 3 is typically, besides day 1, it's typically the longest day of the boot camp. There's a lot to go over, a lot of information, trying to make it all concise. You guys will have access afterwards. But in the meantime, as we go through, I'll be explaining some important notes. But right now, we're going to be going into block 2, the cheat code. Navigating the matrix like a true mastermind. This is where current, new, all students are going to be able to take their trading to the next level by having a specific rule system at a base to take the highest probability of quality trades. This is essentially going to be your quality control. It's going to ensure that you are taking the best trades based off of specific scenarios, specific setups, how to properly manage those positions, and how to yield the highest return from them, right? And something that has been misconstrued from previous boot camps is just because you'll be able to analyze and understand hypothetically any move anywhere, right? With great power comes great responsibility. You need to know that you're not going to be taking all positions everywhere like it's, moonrise to sundown. You are only going to be trading the specifics. That's all. Only the same things consistently. I'm going to say that over and over again, because if you do not, you will never ever be consistent. Doesn't matter what you do, right? And I'm sure that some of you in here, current, new, whoever, you might have applied things and you might have taken losses. And I guarantee you it's because 1, a plan wasn't being followed, or 2, you had the approach as, I understand everything. Now, I'm going to take a trade based off of an engineered liquidity sweep, another trade based off of a decision, another one off of an extreme, different inducement types. You cannot be consistent doing different things over, right? So what this is going to show you, the cheat code, are the highest probability trading setups at a basis. This is just the start line to where afterwards you'll be receiving absolutely everything. Now, this is still extensive, don't get me wrong. So make sure to pay attention. I had to revise some things over the break, cut some things out, so you will see exactly what I'm talking about, but I'm looking forward to it. So this is the cheat code. Everything you need to become profitable out of the get-go, the same setups, ensuring that you're taking the high quality controlled trades. Now let's get right into it. Second here. Small things. Boom. Okay. Getting right into it, everyone. Cheat code. Lesson overview. All right. So in this lesson, you guys are going to be learning the Dreams Effects Mastermind setups, navigating the algo with precision and utmost confidence. Additionally, you guys are going to be learning our ranking system to identify the highest probability trades, right? Learn how to properly manage each prime trading setup, yielding the absolute best returns. Have you ever been in a trade and you didn't know how much to take off, or you didn't know how to maximize your position? Always wanting to hold till it goes to your final TP, or wanting to have the confidence for it to go there, not taking any money along the way. And you end up losing your time watching the trade and your money not working for you, as you're fighting your impulsive urge to either hold all of it or enter more than you should. You'll be learning how to manage. You're going to be learning our unique point system that will provide variety in the approach based on the specific setup, the scenario that you're encountering in the markets. But the variety is always going to return consistency in the approach, always having a very high and great ROI, enabling you to have a killer edge, again, in the markets with the highest and most consistent ROI every single time, every single day. Return on your investment. These setups are present every single day, everywhere. As you guys know, these inducements, the logic, they're all patterns at the end of the day. They're all algorithmic, right? So these are present everywhere. You do not need to trade 5 pairs, 10 pairs. I only focus on 1 pair a day, whatever has the cleanest or the most obvious price action. As with experience, you guys will start to understand what's really clean, what makes sense, picture perfect. Other times, what's not. I only focus on the stuff that is, right? Make your money work for you, and don't gamble. Ensure any trade you take is like any last dollar you have. Trust it with absolute confidence and have the confidence to do well and throughout, right? So now, without that being said, let's get right into it. All right. So, mastermind setups. What are they? You guys now know all the specifics when it comes to the algo, right? Now, again, still very surface level. We can't explain absolutely everything in 4 days, let alone we have many other things to talk about. But your experience is going to come after the boot camp. In the meantime, though, these mastermind setups, they are directly related to all algo functions and all trends, continuations, reversals, internal trends, main trends, counter trend, and anything, pullbacks, all trends they're applicable in. Now, these are going to be the highest probability trading setups that you guys are going to have access to. And what I would encourage everyone to trade, and only these, I wouldn't even worry about anything else. Because if you have the discipline to only trade the same thing over and over and over again, there is profitability, exceptional profitability within that, right? So let's get right into it. All right. So the mastermind probability scale. It's a system that's going to ensure you take the highest quality trades. You are going to be enabled to take different variations of different setups, but it's a specific point system that is going to keep you accountable. So it's going to be up to you what call you want to make, but there are rules and guidelines that go along with it. And if you don't follow them, you're going to be digging your own hole, right? So this is going to make sure everyone has, their own, they can pick their own poison however they want to trade, but it's going to keep everyone accountable to only take the best and highest quality positions, ensuring you're not over trading, you're not FOMO trading, you're only trading with logic and no emotion. The higher quality the trade is, the more of them in theory you can take. The lower quality, the less. Now let's take a deeper look. It's a key to profitability. It's the key to profitability and concept application mastery. It literally entails everything, right? So with this system, to trade maximum, you are only going to be allowed to take 3 trade ideas on a daily basis. Not 3 entries, but 3 trade ideas. If you're looking to sell something, you're only going to be looking to sell in a specific setup for that sell. If you're looking to buy, you're only looking at that specific setup for a buy. Again, entries and scale-ins are different, but this is relating to specific trade ideas. With that being said, the maximum trade you can take at any given point is 3. For each individual classification of trade, there's a different score. The max points allowed as an entire for any day, you are allotted 5 points, 5 strikes, right? The higher quality the trade is, the lower the strike you receive, because it was good, right? You did good, so you should get, you should get, compensated for that rather than, hurt. But if you take a lower probability trade, that's going to be a much more damaging strike than it is, a good one. So let's take a look at this. Inverted stop sign, right? You have your green, yellow, and you have your red classification, your probability score, your probability rank. So what is green? Green, these are the A+ probability rank. This means 85+% of the time, these are going to be winning setups. Like these are the highest of the high, cream of the crop. These are the best mastermind setups. So for each setup that you're going to learn about green, they're all worth 1 point. So hypothetically, in a day, if you have 3 maximum trades, that means you can take at maximum 3 great trades, 3 green trades. That's it, right? And that's 3 out of the 5 points. But it's both a 3 trade max and a 5 point cap, right? So 3 green trades, best trades. I would encourage only anybody to trade those. In the next classification or grade you have is the yellow. The yellow, these are going to be our B+ probability rank. This is going to be 65 to 80+% of the time. You can expect these trades to work out in your favor. These are the medium to the high quality trades. And for each setup you take, it's 2 points. So again, if you have a 5 point total allowance on the day and you can take 3 trades, can you take 3 yellow tier trades? Everyone in the chat, can you take 3 yellow ranked trades if you only have 5 points in a day? No, you cannot. So what can you do? You can take You can take 2 green and you can take 1 yellow, right? You can take 2 yellow and 1 green. The last one is the red. Red is our C probability. This is 50 to 70% of the time this setup will work, right? This is going to be our lower end. Now, of course, I only wanted to put 1, 2 in there because I want you guys to focus on the green and the yellow solely, right? C probabilities are going to be the medium to low quality trades. And these are these are 3 points per setup, typo, 3 points. So if you have 3 points per setup, let's say right out of the bat, you take a red trade and you lose that. Again, this is 3, not 2. So this is 3. If you have 5 points and you lose on a red, what are the other options that you guys can have? Can you take another red if one red is 3 points? No, right? You can't. You can only take 1 red, only 1 red. Now, with red, let's say you take 2 greens and you have a red. 1 plus 1 is 2, right? 2 plus 2 is 4. That's 4 out of 5. Yellow. Can you take 2 yellow trades and 1 red? Can you take 2 yellow and 1 red? Right, Craig? People know basic math. That's what I'm saying. I mean, I can't count. No, you cannot. So it's going to ensure if you want to take a lower quality trade, you're more than welcome to, but the leash is going to be pretty tight because we don't want to steer you off point. We want to make sure you're only taking the best trades. So now you'll see there's some variety between the green, yellow, and red, especially with the setups you guys are going to see. So what I would encourage on a daily basis, I'd focus on 2 green, 1 yellow. If you're really, really feeling it, I would say 2 green, or I would say 2 yellow, 1 green, right? That's all that I would focus on is yellow and green. I would say scratch the red, but if you have an itch you can't scratch, and go for it. But just know once it's done, it's done. You're not chasing it. If you chase it, I'm going to directly ask you, well, why are you losing? Are you following the probability scale? Are you following the rules? No. Well, then you have a discipline problem. We got to work through that, right? So this is going to ensure everyone is going to be kept accountable and have discipline following this. If you follow this, being profitable is not a guarantee, but it is pretty effing close to a guarantee. If you do not follow this, that is a guarantee to failure. I can 100% promise you that. All right, so let's get right into it. The first half of this, or majority, it's all going to be continuation, right? So like we said, we have continuation and reversal setups. We're going to take a look at the mastermind setup for continuation trades. Now, again, a lot of note taking, so be prepared. And this is our green category, right? This is our green category, 1 point. The first type of trade, one of the top 3 highest probability, is a type 1 extreme that follows order flow. Overview. What is this exactly? Everyone go ahead and draw this out. While I'm drawing it out, I'll give 10 seconds before I go ahead and explain. So what's happening in this instance, right? Your type 1 extreme. What is it on the chart? Again, a type 1 and a type 3 are very close. They're almost the same, right? But the difference is a type 1 is the main structure on that time frame. It actually ends up being broken, right? So what happens when this structure is broken and you see an extreme right above that follows order flow, this is what you want to focus on, right? So it's a type 1 continuation when the current higher high or lower low, in this instance, when the current lower low mitigates a previous SMT. This tells us over here, again, on a fractal level, clear this. This tells us on a fractal level that if we see something that looks like this, again, your type 2, think about it fractally, your type 2 over here, if we're main cells, this tells you how to find your entry. Doesn't matter if this is a scale in, it doesn't matter if it's a main POI, This is what you want to look for. So over here, if you have your SMT that's mitigated, the first best entry you want to look for is going to be your order block that follows extreme. And I know for certain you guys have seen this happen many times today. This is why it's one of our highest probability trades, because it happens every single day, right? So what happens is you want to make sure you're identifying your extreme, but most importantly is that it follows order flow, meaning this extreme, right? If you have a type 1 here and you identify this as your extreme, make sure your extreme mitigates another order block, whether it's another decisional or it's an extreme, it doesn't matter, but make sure it mitigates something. That tells you tells you the institutional order flow is intact. So that's the very, very high probability area, right? When order flow is present as such, it's even more important. Now, is that a requirement? I really want to say yes, it is. But if you have whatever reason, without a doubt in your mind, this is it, this is perfect, you can still go for it. But just know order flow is the key to this entry. If you want to follow rules, only do that. Order flow. Now, as far as trade management for this, trade management, right? For the first few, it's going to be written out. For the remaining, we have to sketch them and I have to show you exactly why. Trade management, the trade management for each different setup is going to vary. If it's pro trend, if it's counter trend, so on and so forth. In this scenario, because we have an SMC here, and if this is your entry, right, you really, really want to trust with a high degree of confidence that this is where price should go. Now, again, if this is a true SMT, this will happen. But if you mislabel this as an SMT, and let's say it's a correct order block, well, then that throws everything off. This will be obviously a BOS, and then the opposite will happen. So what I would say, what I do is I'm confident in my TPs. If this is a true SMT and you have practice, I would say at this first TP, immediately take off 60 to 75% off of your position immediately. That is what I would always do. You're never going to go broke taking profit. And with this, you can, I'm not going to talk about risk right now, but you can be very confident it's going to break this low if you're right. I would say 95+%, it's going to break here. Regardless, still take positions. For now, I'd say 60 to 70% of your position at 75, 70, I would for sure take off right here. So your first TP. Now your second TP, your TPs are always going to be based on inducement and engineered liquidity. So with that being said, if this is your first TP here, let's say you have this over here. This is your first TP. Where's your second TP going to be? Your second TP is going to be at your engineered liquidity. Now it could be right below, it could be a substantial distance. If it's right below, right, again, case sensitive, I would just mark this as your TP1. Again, I can't explain all scenarios today, but your TP2 is going to be your engineered liquidity, right? Your engineered liquidity. Here, I would then take another 15 to 20% off of your position. And again, I'm viewing this as a whole. Let's say you have your whole position is 100, right? If your whole percent is 100, take off 60 to 70 here, take off the remaining 15 to 20 here, and then your final TP where you should leave anywhere between 10 to 15% running until it actually hits that point should be, again, not drawn to scale, of course, should be new lower lows. That's where I would leave on, 10 to 15% of your position until it hits here. Then I would close all out. Again, it's very case sensitive, but having a guideline is at least going to make sure you have rules in place so you're not going to have bad habits from the start. Obviously, this is just the beginning, right? So that's what we have for the first type of inducement, type 1 extreme order flow. When you're done with the notes, I'm going to flip this actually on the opposite end now so you can see the buy scenario. The buys is, of course, the inverse, right? So this happens when you're in an uptrend, Now, if you are structurally bullish, right? Let's say you have an SMT here. and you are structurally looking for buys. Well, what's going to happen, right, is you're just going to be following order flow, the trap, following order flow, right? So in this instance, for type 1, we look to buy below the main leg higher low, right? So as soon as that is taken, you identify your order block, make sure it's following order flow, and then enter here. I know those of you guys who have seen the setup, you guys have seen this so many times. It's one of my favorites. It's phenomenal, right? So using this, same thing. Take off majority of your position at the new high, right? At the new high. So I take off 60 to 70% here. To the left, next thing I do, your engineered liquidity, take off the remaining 15 to 20. And then at your swing, your higher time frame major inducement, whatever it might be, that's where I would take off the remaining 10 to 15%, however you want to manage your position. But have numbers as a baseline so you can refer to them. Oftentimes, this is overlooked by students. This is so important, so important. All right. And then again, hedging, that's in all honesty gonna be way too much to talk about today. Hedging is just as if this were an SMT and this was the right order block. Well, in this instance, you would just hedge from here if you hypothetically got it wrong, right? It's just the inverse of this. So hedge position, I think we're just going to skip over that for these so we can fly through because we have a lot to get through. All right, everyone type a 1 when you are done with the drawings and the notes. Awesome. Right, ready to move on to the next one. All right, now our second highest probability, and personally one of my favorites, all the high probability are my favorites. This is going to be our type 2 extreme, right? In this case, this is where we are assuming the higher time frame structural leg is going to remain intact. Compared to the first one, it broke it. This one, it's going to respect it. So it's going to respect the range when your SMT that's mitigated lies obviously at liquidity. And again, similar to the first that we just drew, this is going to be in a downtrend. This can happen. This can be the trap. This can be the stack following the order flow. It's not just one way it can appear. There's a few different ways, but it's still the same logic. So here, right, you can be in a pre-existing downtrend. Doesn't even matter what it looks like. But make sure it follows order flow. This little line here illustrates order flow being respected. So specifically, where is the type 2? Again, over here, you'd be selling above an internal right high because you have traders who are getting stuck on this time frame. And then what happens? Price then, reverses. So this is what I'm referring to. I don't want to jump the gun here, but even here, this ends up being this on a fractal level. It's even your entries, your scalings, whatever they're going to be, it's all the same setups. It's just literally repeating the same thing over and over and over again. And I know most of you guys will have your breakthroughs when you know exactly what I'm talking about. Just one big puzzle. So as far as this one, right, type 2s, this is where you want to try to have a ton of confidence. But for starters, what I'm going to say, your TP1 should lie right at this immediate low right here. Now, this is different from the first example because this TP, you're taking off a very, very, very small percentage. Here, you're going to take off anywhere between 10 to 15. 10 to 15% at that first inducement, right? Your first inducement. Why? Because what can happen is price can come here and then what? It can go higher, right? So we want to make sure at least you're going to cover your stop loss, whatever it might be. So I would say that first internal inducement, take off 10 to 15%. Your ideal target now is going to be a new structural lower low. Now, this is all assuming you're analyzing correctly, right? So if you take 10 to 15% off at your first TP, which is here, again, it's very specific, important you note that some first TPs are going to be much more, some are going to be less. Your second TP, this is the overall goal, right? So at this area, you should take off another 60% or so, more than half your position, right? More than half your position I would take off here. And again, the reason being, because what? How many times have you guys seen this? It can just come back up and then it can drop. It's how we maximize our money. Don't be stingy leaving it on the table, because then you won't have anything else left to eat. You're then going to take off 60% of your position here. So at this point, when price breaks this low, 70 to 75% of your position should be off. And now, as far as your TP3, again, we're doing this. Your TP3 should be your new structural lower low. And at this point in time, this is where I would go ahead and take off the remaining 25 to 30% of your position. 25 to 30% here. So all of these are just how much you're taking off from the whole, not like from each individual, for those who know what I'm saying. Yeah, this is where I would take off the remaining 25 to 30, 20 to 30% at your swing. This is smart trading, right? This is smart. Oh, no, hold here, 1 to 20, 1 to 30. Once you learn how to get funded, 1 to 20s, 30s, 40s, they don't mean anything. Can you still do them? Absolutely. But the goal is to get paid. It's not to be perfect, right? So if you pay yourself, get used to understanding what it's like to pay yourself, then you start to understand what the purposes of trading. If you can manage like a portfolio manager, that's how you're going to become a trader and not just an analyst like everybody else. Exactly. The compounding is huge. All right. And that, again, that doesn't mean you're going to have one entry. You could have multiple, but not on that segment yet. All right. So everyone, once you are done with this, I'm actually going to now flip the script to buys. So you guys can see the same thing. Again, your TPs in this scenario are going to be here, here. Maybe you're bullish here. It would be here. Again, the same thing. You have your 15, you have 10 to 15, you then have your 60%, then you have your remaining 20 to 30% at your final TP. The reason why we take majority off here, as I just previously mentioned, is because we can come back down here, use this as an inducement, and then go higher. I know that's happened to some of you guys before, and this is why when I manage my trades, I won't break even, because I know this is still a valid POI, right? Why would I break even if my trade idea wasn't invalidated? Just because something happens that you don't want to happen doesn't mean it's invalid, right? All right, so once everyone is done drawing this, please type a 2 or a 1 in the chat, and we will continue. All right, let's see. All right, now let's go to the next example. So be our type 3 extreme, our type 3 extreme, right? So here, go ahead and copy these down, and then we will go right over it. You're going to notice they're the inducement types. So even if you don't think that they're important, I can most certainly promise you they are. And again, you're not just worried about, oh, it's a type 3 inducement. It's identifying the order flow. It's identifying how the partialing works for all of these, what they react to. This, without a doubt, these SMTs are key. They tell you how price is going to react, right? So me going through these, it's more than just the inducement types. I could just say the inducement types, right? There's specifics when it comes to the order block relevance, what's following order flow, where you can assume these are going to be. Like, where would this scenario be? Well, if we're looking for buys, obviously, oh, here's a sell. Oh, well, that tells me down here, maybe we are structurally bullish, right? And it's like putting together a whole fractal and understanding. Like this, for instance, was exactly like US 30 Thursday, Friday, for instance. I had these sells, knew the buys could work out exactly like this. I chose to continue to look at the sells. It was a great trade, got broken even, but then of course price ended up going the opposite direction. So just something to always be aware of. There's always a purpose. It's bigger than a pattern. It's why is the pattern happening and where, and then how to manage it, of course.